Okay, 30 more seconds till we report back from each table the key ingredients for a great place. So choose the person that's going to do the reporting. Write down your keywords if you need to. All right, so we're gonna move on. So we have a table volunteering here to my left. Yay, key ingredients for a great place. TJ.
Well, I mean, I'm sure we'll hear a lot of people. A place being designed at that sort of human scale for people to have interactions and sort of organically interact with that space, as opposed to what can be the corporate sterile look of like pretend for people, but actually for people.
Awesome, thank you. Can we go? Yes, thank you. Next in line.
Upstairs.
Yeah.
Okay. And we have to just give one.
You can give sort of the key, the recipe, I suppose, from your table.
Just building on what was already said, a reason to be there, such as programming, like a specific event or activity, or even like a retail place or a cafe or something like that. Just a reason to go and
good one, yeah.
In that place. Good design, which was already said, and connectivity and accessibility.
Perfect, thank you. It's a good recipe. Next table.
Some can be around public things as well. A public space of some sort. In the small towns, very often it used to be the post office or the small store where people gathered and then they kind of moved to a restaurant. Yeah. And so that could be. I often regret that we didn't put our postal boxes at our community house.
So a gathering space or something of that nature. Yeah, great. Thank you. Last table?
Some of the things we mentioned, you just want one?
You can give us a selection.
A reason to be in that.
I can write smaller.
A reason to be there. So a destination.
Yeah.
One of the examples we talked about was the improvement of a real coffee shop, but also high quality material.
Awesome. Was there anything else you wanted to share? That's a great one. Yeah, perfect. So I think the keywords here are definitely revolving around people, organic interactions, programming levels, reason to be there, good design, connectivity, accessibility, public space, places to sit and chat. So how do we do that? How do we get there? And that's the million-dollar question. So I'm going to now turn it over to Antoine. So he's going to build on that framework and tell us about how deals can help us get there.
All right. Yeah, so I have a pretty varied background. We've done a lot of different projects. Back in 2011 and 12, we launched a renewable energy-powered carnival. That was a not-for-profit educational platform to teach about clean technologies and energy literacy. Then we started a company that builds high-density commercial lettuce farms and shipping containers. So these are both kind of crazy projects, high-risk ventures, and I have 4 children. So at the time, I thought I need a hedge against these projects. So I started a company called Boring Investments. And Boring Investments was just a hedge against this other stuff. We were just buying buildings that cash flowed really well. And so we got really deep into what is the engine of a commercial asset that allows it to be viable and generate revenue. But then we started getting into projects that were not just boring. I mean, they were boring in that they were designed on the basis of cash flow and reasonable leverage, and they were assets that are designed to withstand some of the volatility that we experience in the Alberta economy. But we started buying buildings where we had really cool restaurants and music venues, and where they were located in strategic places that were important to a neighborhood. And that's very fulfilling work for us. And so we're really seeing the opportunity to do development work where we can build spaces that enhance the cultural fabric of neighborhoods, and also where we can design our spaces in a way that strategically support the entrepreneurial ecosystem in the city. Because at the end of the day, we can build all the best restaurants in the world, but if people don't have jobs and our entrepreneurial culture is not strong enough to withstand all of the changes that are happening in the 21st century, then no one's going to be able to afford to buy dinner. So economic resilience, cultural vibrancy and economic resilience are two kind of key design parameters that we consider when we put projects together, and that are an important part of city building. So some of the projects we're working on, if you want to just go to the next slide. This is the Gibbard Block in the Highlands. So this is a 100-year-old building, about 10,000 square feet on a little, it's one of the few kind of main streets that has survived the decades in our mature neighborhoods in Edmonton. So this, in the Highlands, there's this strip of 2 or 3 blocks that have these little boutique gift shops and a bodega and a little coffee shop. It's really quite beautiful. So, and this building has been not upgraded in a long time. So we bought it, and this is a project that we're doing that's very much targeted at enhancing the cultural fabric of neighborhoods. We have another project on Jasper Avenue that is called the Brighton Block. So this building has been vacant for 12 years. It's an iconic heritage building in Edmonton. It's been begging to be activated for a long time. Again, very challenging project, but worthwhile. So we're no longer in the boring category. Now we're really getting into enhancing cultural fabric. So I give these projects to you as examples of ways that we're approaching city building. And to put a project like this together, there's really 3 core ingredients that are needed. You need some markers that work. All right, I'll try this again. So there's 3 pieces that are needed to put a project together. The first one is capital. Well, maybe that's the second one. The first one is you need a property, so land or buildings that need to be developed. There. And then you need an operator. The thing is, in Edmonton, so what we find is if we have a property and we have a committed operator who's going to lease the space, then we have the capital. There's really not a limit to capital if you have like a packaged project ready to go. Also in Edmonton, we find there's not really a limit of land and buildings that are begging to be activated. There's quite a few big pockets of land that you just walk by them and you're like, this could be a little town. So this is not a limiting factor. This is not a limiting factor. For us, if we want to create spaces that are meaningful in our city, then that means we need to find operators who are doing meaningful work. And for us, we categorize meaningful work on 2 tracks. On the one hand, it's operators whose work enhances the cultural fabric of neighborhoods. So some of the stuff you mentioned, gathering places, community hubs, cafes, neighborhood services like post office or hairdressing, barbers, places where you're likely to bump into your neighbors when you go there to partake of goods and services that are offered. The other track that we consider to be meaningful is operators whose work contributes to the resilience of the regional economy. So we're talking about innovation, technology, manufacturing, people who are exporting products out of the region. These are all primary economic activity. So we know that this is not a limiting factor. This is not a limiting factor. The limiting factor is that there's not enough operators doing meaningful work in the categories as we define them, who also can represent commercial covenant. Right? So that's an interesting piece, is that there's this threshold here that is constituted of like the ability to comfortably and responsibly commit to a 5 to 10 year commercial lease. That's a meaningful threshold, especially for some of the smaller companies at the community level. And so this is the limiting factor. And so for us, if we have a strong operator whose work is meaningful and who can represent covenant, we have a project. The value is here. This is 100%. This catalyzes the entire project. If we had 100 operators doing meaningful work who represent the covenant, we could build 100 Gibber blocks across the city. I mean, we can't rebuild the heritage building, but space is almost as cool. So, what does it take to expand this circle? Right? Like if we're talking about creating more wonderful spaces across the city, then we need more of this kind of activity to be robust. And so if you kind of zoom in a little bit to what is going on at the operator level, they have their own trifecta, right? So if somebody wants to bring some amazing new concept to the city, they need to have capital to launch. They need to have operating capacity, right? So this is, a lot of this is expertise. This is the entrepreneur's knowledge of how to architect their business, how to set up supply chain, where to find staff, how to develop protocols and procedures to operate the business efficiently, equipment, all of that. This is all about operating capacity. But the core driver at the operating level is also leadership. It's the same kind of principle. It's that if we have somebody who has a great idea, who has the ability to mobilize and inspire people, and is committed to see their idea through, that constitutes leadership. And then the rest of this can be built around that leadership. This is not quite zero the way it is in development in Edmonton, because these are often specialized sources of capital. And like, for restaurants, for example, you need to know how to underwrite restaurants to invest in restaurants. What to speak of some of the new technology sectors that are emerging in the capital region. A lot of Alberta investors don't quite know how to understand some of these technologies and how to underwrite them. So this is specialized capital. This is also specialized operating capacity. So sometimes these are rare resources too. But the point here being that there's a limited circle of operators who constitute covenant or doing meaningful work. And there's a slightly larger circle of operators who are almost there, but maybe just have some gaps in their operating capacity, some gaps in their access to capital, some gaps in their access to markets. And so if some of these gaps can be supported in the entrepreneurial ecosystem, then more of these operators can constitute covenant, and we can build more projects around them. Another way that this can be addressed is you can lower the bar. You can lower the bar by providing commercial spaces that are more accessible. So co-work spaces provide this, where a tenant can come in. They don't have to put a lot of capital into improvements in a space off the bat. They don't have to commit to a 5-year lease. They can commit to 6 months or a year. They're smaller footprint spaces, so it's not as onerous of responsibility the lease they're taking on. So there are different ways to address this need, but generally it's just good to be aware that part of the reason that our cities proliferate with relatively homogenous types of businesses, like their suburban environments are often a lot of national chains, because those companies are strong, and the banks like that covenant. They know they're going to pay their rent, so they know they're going to have their mortgage paid. And whereas the local operators and the smaller businesses that really make our cities diverse and our communities diverse, there's more risk involved with those types of companies. And so there is like this. I was speaking with Cheryl Watson a week or two ago, she works for EDC, and she was speaking with some VCs out of San Francisco, and they're saying, if Albertans were only as passionate about entrepreneurship as they are about hockey, you'd be the innovation capital of the world. And they're talking about, and I was saying that the reason that we produce so many amazing hockey players in Alberta is because we have this ecosystem of where every micro step in the progression of a hockey player from a 3-year-old to a NHL player, there's a step there that's been architected. It's like mountain climbing with rods in the side of the mountain. It's a very safe path. I mean, not everybody makes it, but the whole path is mapped out, and there's support at every step of the way. Whereas for entrepreneurship in our cities, there's this kind of no man's land, and that where people are operating out of the basements and they're growing out of the spaces that they have, but they aren't quite ready to commit to the 1,200 square foot bays that are available for commercial use. So this is a bit of the landscape and some of what we see around the limitations of expanding wonderful cultural spaces in our city. So this is, I want to get into a little bit of what drives this, what the numbers are, and how an asset performs. And it's not just about making projects profitable as possible. It's about how do we make this feasible. And as planners, if you understand some basic commercial literacy, then you can know pretty easily whether a project is viable or not. And so we'll get into that. Maybe can we hang this up somewhere? So there's, I'm going to talk about three key principles or metrics. One is NOI, or net operating income. The next is cap rate, or rate of capitalization. And then we're going to talk about property values. And I'm going to ask you guys to do a bit of math. So just want to warn you in advance. So who's familiar, raise your hand if you're familiar with these terms. Yeah? Okay, about half the room, more or less. So it's actually really simple. And my hope is that you can walk away and you'll have a grasp of this that's strong enough that you can do this math on a napkin in less than 5 minutes on any project. And I'll show you how that works. So net operating income is, it's the income that's left after, so you have your operating income, your rents, and maybe laundry, or depending on the building, what parking revenue. There can be various types of revenue in a given asset. That's your operating income. Then you have your operating expenses. So that's your utilities, your property taxes, your property management, your insurance. Those are your operating expenses. Not including interest. So no debt servicing, no taxes, no depreciation. That's not included in operating expenses. So you go operating income minus operating expenses equals net operating income. Okay. So what's important to notice here is that we stripped debt servicing out of that equation. So net operating income is basically what your income would be on the building if you paid cash for it and had no mortgage. And the reason can anybody suggest why do you think it's important to look at the property's performance independent of financing that's attributed to that property? Any takers? So if you want to compare one commercial building against another commercial building, why would it be important to look at it as with debt removed from that equation? Yeah, that's right. And what could be different between two debt scenarios on one building versus another? Yeah, exactly. Yeah, so one mortgage might have started in 2014, one might have started in 2016. They could have two different interest rates. So that tells you nothing about the quality of the building or the performance of the building. That's just timing of when the mortgage was set up. Also, a mortgage on one building might be at 50% loan to value. A mortgage on another building might be at 70% loan to value. So the debt servicing on the second building will be a lot higher. So that's going to impact the cash flow, but that also doesn't tell you anything about how one building performs against how another building performs. So net operating income is an important measure that allows you to compare apples to apples. And so it's important that you disregard debt servicing in that equation. Okay? So operating income minus operating expenses equals net operating income. Now, this is important because commercial buildings are universally valued on the basis of the income they generate. So that's quite different than like a residential property where, it depends how pretty it is or how comfortable it is or how close it is to your grandmother. Those are other factors that'll influence residential property values. But in commercial real estate, the banks, the investors, the developers, all the stakeholders that are involved with putting capital into a commercial asset, they use this as the key metric to determine what the value of the property should be. Now, the value of the property is calculated from the net operating income through a ratio called the cap rate. And it's pretty simple. And the easiest way to just start to get a feeling for this is to know that in Edmonton, the cap rate, generally speaking, for commercial properties, specifically retail and office type properties, and even industrial to some extent, tends to be around 7%. So that means if you're buying a building for $1 million, you want that the net operating income is going to be about $70,000. And if the net operating income is $50,000, then it's not worth $1 million. If the net income is worth $100,000, then it's worth more than $1 million, or $1 million is a really good price. And it's really that simple. So this is a relatively arbitrary cap rate. This is affected by market demand. So for example, if you go to Vancouver, you'll find that people will buy pay $1 million for a building in Vancouver that generates $40,000 of net operating income. So that's a 4% cap rate. And buildings in Vancouver trade around a 4% cap rate. Why might that be? Why would they, if they can buy a building in Edmonton at a 7 cap, why would they buy a building in Vancouver at a 4 cap? Yeah, right. A lot of it has to do with speculation. So part of it might be prestige, or there's like a fundamental economic reason to pay a higher price to be in a certain region because it might be really good for your business. So you pay more for a building there. But often it's speculation in a market. And so the buyer here is not looking at the cash flow as the important metric that'll determine what they're willing to pay for a building. They're looking at, we're going to double our money in 3 years because the asset's going to appreciate in value. So we don't care what the cash flow is. We just want to control the asset so we can ride that wave. So that's called cap rate compression. So in high demand markets, especially where there's a lot of speculation, cap rates will be compressed down. And at a 4 cap, you can't actually, this property won't cash flow at 70% loan to value. We can borrow against commercial assets at around 70% loan to value on average, 65 to 75%. But it won't cash flow. It'll be negative cash flow if you go 70% loan to value with a 4% cap rate, typically. On the other hand, you might have regions that are where you have population is decreasing or businesses are leaving. Sometimes in rural areas, there's more volatility. And so investors may perceive that area as higher risk. And so they might look for an 8 cap or a 9 cap or a 10 cap on their property. And they may say, if we're going to pay $1 million in this neighborhood, we don't know what the population is going to be in 10 years. So we need to see $100,000 on $1 million purchase. Is this making sense? Yeah. So this is, and another thing too is inside of a city. So if you're on White Avenue or you're on Jasper Avenue, you can have locations where you have very low risk of vacancy. And so an investor might go down to a 6 cap on those types of properties. So this number can vary, but this is a good principle to consider, that on average, the prevailing cap rate, that's the technical terminology, the prevailing cap rate in the Edmonton market for commercial property tends to hover around this 6 to 7%. So from a value perspective, if you go $70,000 divided by 7% cap rate, you get your $1 million property. And that's how simple the math is. So value equals NOI divided by cap. Okay, so that's making sense? Good. Okay, now we're going to run a live project. You guys are going to do some math. So do you have the Westmount building? Oh, okay, no problem. So do you guys know, who's from Edmonton here? Okay, most of you. Do you guys know where Range Road Restaurant is in Westmount? Okay, so this is a project that we did. And I don't know, do you remember what it looked like before? What's that? Yeah, the Blue Pear, that's right. So Jessie Rudy's a local economy, like the grandmother of Edmonton's local economy movement. She's amazing. So yeah, she had the Blue Pear, and then Range Road bought it. And when we bought the building, there's on the old photos, there's a big patch of black on the side of the wall. And that's actually where the bricks fell off the wall into the parking lot. It was a horrible building. And Range Road is one of the best restaurants in the city and one of the ugliest buildings in the city. So we bought the building and we invested in some improvements for the aesthetics and the energy efficiency of the building. But when we bought the building, there's about 11 tenants in there, and altogether they generated about $120,000 of net operating income. This is a good point to who raise your hand if you know what a triple net lease is. Okay, just a couple. Okay, so this is important. So all commercial leases, typically, with the exceptions of sometimes mom and pop kind of property owners who don't know what a triple net lease is either, generally commercial rental is on the basis of triple net lease. So that means that in the lease agreement, there's a base rent that the tenant pays, and there's an additional rent. And the additional rent is the cost of all the operating expenses of the building. So insurance, property taxes, property management, maintenance, utilities, all of that. And the way a triple net lease works is the landlord and the property manager, they budget the operating costs for the year, and then they charge the tenants for those operating costs on a monthly basis based on the budget and pro rata based on how much square footage that tenant controls in the building. At the end of the year, there's a reconciliation. And so if the property management spent less money than budgeted, then the holding company writes a check back to the tenant and they get a reimbursement. If it went over budget and more money was spent than what was budgeted for on the operating costs, then there's an invoice and then the tenants pay the difference. That's how a triple net lease works. And so it's like a flow through where all the operating costs of the building are the responsibility ultimately of the tenant. So that's important to know just from a dynamic perspective in terms of how our commercial spaces operate in the city. But also, it makes the math really easy because base rent in a triple net lease is almost identical with net operating income, right? Remember, net operating income is operating income minus operating expenses. If the operating expenses are 100% flow through to the tenant, then operating income is equal to the base rent. Does that make sense? Okay. So, all right, so we're buying a building with $120,000 net operating income. What would you pay for this building? So I'm going to give you like a couple minutes and then just figure it out and then talk to your neighbor. You can compare, you can cheat, compare notes, and then I'm going to ask you what this building's worth. Remember, here's the math. $120,000. Pretty much. Yeah, pretty much. There was some upside in the rents though, but so the question here at the 120,000 is, you know, assuming that that's, we'll get into adding value in the next part of the math. All right, you guys ready? Who wants to volunteer a bid? I don't know how to do the auctioneer thing, so. How much? $1.7 million. Any other? Anything off of this different? No. No, that's it. We paid 1.67, and the reason the $30,000 is because the previous owner had already tapped into the facade improvement grant, so we asked him for the discount for that. $30,000 he had spent. So, all right. Good. So it's that simple. Like that. So it's all. We're going to get into some more detail around IRR and how the capital, the banks and the investors look at an asset, and it gets more elaborate. But the high level rule of thumb metric is that it's that simple. And so then we'll talk about adding value. So with this project, we bought it in this condition with the bricks falling off the thing. So yeah, there were vacancies, but there's a reason there were vacancies because the building was terrible. And so we invested about $500,000. And I'm going to explain a little bit too about how the financing works around a project like this. And this is a small example, but all these principles apply even to towers in our city, right? So to make this deal happen, we paid 1.7 for the property, and we plan to put in $500K in about $500,000 in improvements. So that would get us to about a $2.2 million project cost. So when you go to the bank, they lent us 70% of the purchase price and 100% of the construction value. So the mortgage ended up being $1.9 million. And this we had to pay back in 18 months, right? So we're buying a building for 1.7, we're borrowing 1.9, and we had to pay it back 18 months later. So that's the imperative, and every development project has some version, some analog of that imperative. So how are we going to pay back this money? Well, we're taking the $500,000, we're investing it into the building, and at the end of the day, we need to get to a value here so that once it's stabilized, because the point, in order to pay this back, we need to increase the value of the building. How do we increase the value of the building? Increase the net operating income. Yeah, that's right. So how do we increase the net operating income? Fill vacancies, raise rents up to market, right? So exactly. So now that represents some risk, because we're going in this building, we don't know what's going to happen when we go to the tenants and tell them, look, we're going to put a new boiler in, we're going to put new electrical throughout the building, we're actually going to insulate the building, because there was no insulation at all. It was just drywall, studs, and then the exterior shell, nothing in between. So we go to them, we're going to improve the building for you, but we have to raise the rents. And we didn't know whether they can afford more rent. That's a risk scenario for the building. And but what happened is we went to all the tenants and they were ecstatic. And we ended up raising the rents pretty substantially to make sense of this cost. And so, but they were all very happy about that. In fact, Range Road doubled the footprint of the restaurant, which they needed to do. So we got over about 14 months, we raised the rent to $206,000. And the point is that this new value has to be enough so that when we go to refinance at 70% of the new value, that the amount that we're able to draw down from the financing is enough to pay out the construction loan. That's the imperative. If for a building that you're renting to keep, right? We're not talking about selling condos in this scenario. So, all right. So now, did we get there? What do we get for property value at $206,000 net operating income? 2.8. Yeah, 2.87. Yeah, about that. Yeah. So, exactly. So we raised the net operating income from 122.06. That means we raised the property value from 1.7 to 2.9. And the proof is you go to the bank and they agree with you. So in this case, we went to the bank, we got 70% loan to value. That was more than enough to pay out the debt, and we had some cash and we put that in some other buildings. So this is the math, right? And it's that simple. This is the math that determines what a building's worth. This is the math that determines what's possible in improving a building and realizing upside. If rents are below market, if you can improve the building and add value so people are willing to pay more rent, then you get this value. So that's how the commercial metrics work. I think that gets us where we need to go. Do you want to talk a little bit about, do we have time for you to get into the IRR stuff a little bit? Tee it up? Okay. Any questions about this? Okay. Okay. So if you go 206,000 divided by 7%, it will come out to somewhere around this number. I'm trusting in, can't see your name tag, but you look like you're good at math.
14 and a half times your
Right. Yeah, exactly. You had a question? The return that comes directly to the owners and the stakeholders, the shareholders. Yeah, that. In what the return should be? Okay, so Jarrett's going to speak to that. And so we do our metrics on internal rate of return, or IRR, which is just a metric that takes into consideration the time value of money. And that typically is around, for our investors, when we're attracting capital to fund these things, they're looking for generally around a 12%, 12 to 15% return. Yeah, on an IRR basis. That's the equivalent of a compounding rate.
Working? Okay. Yeah, I won't get, so I've got, I built a spreadsheet out yesterday that takes some of these numbers and sort of throws them into, it gets pretty complicated, but we're gonna have a break and everything, and after that I'll show, but just to sort of set the tone. So, these principles are, at a high level how, we would look at real estate, as sort of developers and redevelopers and things like that. But when you think about it from an investment standpoint, and so we go to somebody and we say, hey, we need money to invest because we can go to 70% loan to value. An investor always thinks about what's my return. And so there's a few different ways to look at that. And the one we look at is known as the internal rate of return, an IRR, which is a bit of a complicated formula, but it sort of takes the notion that you've got some money, you could do different things with it, but ultimately that money should be earning you a return. So as it comes to real estate, you're going to put money in and you're going to get money out, and you're going to get money out over time. And depending on how long it takes for you to get the money back, how much money you get, that all distills down to sort of an IRR. So if I put $100 in and I'm going to get $120, I get a 20% return. But there's a difference, because if I put $100 into a project and I get $120 next year, that's pretty good. I get 20% in 1 year. But if I get $120 10 years from now, that's obviously far less valuable to me, because in the meantime, over that course of 10 years, what could I have done with that money? I could have done other things with that money. And so IRR tries to capture not just the return, hey, I made 20%. It tries to capture, I made 20% in 1 year versus I made 20% over 10 years. And had I made 20% in 1 year, I could have taken that 20%, I could invest into something else. And in year 3, I could have made a return. In year 4, I could have made a return. So as it relates to, thinking about projects, so when you think about this project from an investor standpoint, who's not, pulling all the levers, they put money in, and in a redevelopment scenario, they took money out. So, if you put it into a spreadsheet, and I'll show you guys the spreadsheets, because, it's somewhat easier to understand if it's like month 1, you write a check. Like, you write a check from your bank into another bank account, and you as the investor, it's a gray box. I mean, you want information, but you don't need to know everything. So then you give Antoine a check. Antoine goes, he's doing his thing. You're off. If you're a good enough investor, you're down in Palm Springs, you're golfing, and you're hoping that he's going to get you a bigger check down the road. So, and then in this particular case, there was a redevelopment process, and so, he might give you an update every month, and then, 16 months down the road, he goes, hey, we refinanced the building, like we said here, and there's extra cash. I could cut you a check now, or we could reinvest that. But for simplicity, we'll just say you got a check back. So then, as an investor, you go, okay, I put money in, and I got money back. And then the next month, I'm going to get some money, and so there's rent, net operating income, and that flows down, and then you've got debt, and so then there's going to be something left over. And so what you end up with is a series of cash flows that spread out over, let's say you hold this building for 10 years. So for 10 years, every month, there's going to be something. And so you as the investor would look at that and say, I put a certain amount of money in, over 10 years, I received a certain amount of money back. That distills down to an IRR. And, like Antoine said, we're looking, our investors are looking for 12 to 15%. And hopefully some of this will be a little clearer once I can actually show a spreadsheet that spreads out. And so when we think about net operating income, that allows us to get a certain amount of cash out of the property, but also allows us to finance. And so when we think about cap rates and value, what a building is worth on a month-to-month basis doesn't actually make any difference. I mean, you've got leases; those tenants are putting checks into your bank. You're cutting a check to the bank that you've got giving you the mortgage, and then you're left with something left over. Hopefully, you're left with something left over. That's not always the case, but if you've made a good investment. And so if a building value goes up and down on a month-to-month or year-to-year basis, if you're holding that building, it doesn't make much of a difference. But where the value and the cap rates come in, and the NOI make a difference from an IRR perspective, are when you refinance the building, because a bank will say, I will give you 70% of whatever this building's worth. So, so at this point, you take, so when the value went up to 2.87, based on the 206 of net operating income, the bank says, I'll give you 70% of 2.87. And so if that 2.87, Alberta, you've got a 5-year mortgage, by the time you go back to the bank to say, okay, haven't seen you for 5 years, how are things going? I mean, that 2.8 could have gone up, it could have gone down, it could have gone up and down. I mean, it's 5 years in Alberta, it's a long time. I mean, just look at what's happened in the last 5 years. And so then 5 years down the road, you go to the bank, and that's when it matters what your building's worth. What's your NOI, and what's your cap rate? Have your rents gone up? Maybe you've gone over 5 years, your rents are now at $230,000. But maybe, now it's on 124th Street. 124th Street is a new hot area. People used to pay a 7% cap rate because they felt the risk, but it feels a little bit more like White Avenue. It feels a little more safe. It feels a little bit less like you're going to not have vacancy. And so, okay, the cap rate's now a 6.5%. So your building value's gone up, and the bank will give you a little bit more money. So 5 years down the road, it's like anybody who's got a mortgage, when you renew your mortgage, you can take cash out if you want. So if the investor, again, he's down in Palm Springs, he kind of remembers that he has this building in Westmount that Antoine's taking care of. 5 years down the road, your building value's gone up, you refinance, you've paid down some of the principal, and then you get a cash flow. From their perspective, they've got, maybe a couple dividends over that year, and they get a chunk of cash 5 years later. So now let's go 5 years down the road, and now we say, okay, we're going to sell the building. Again, what had happened, the building had gone up. In the first 5 years, in the second 5 years, it could have gone up, and it could have gone down. But then we say, okay, 5 years down the road, we're going to sell the building. Now it matters again, what was the cap rate and what was the income? So maybe the income's gone down a little bit. Maybe the Alberta economy struggling. There were some people. One of your tenants went under, and the new person couldn't get there, and so now this has gone down, and cap rates have gone up. Maybe Edmonton's not as attractive, and so then now you go to sell it, and so what you sell the building for has gone lower than what it was 5 years, but as long as you've got, so then you'll end up with some cash at the end of it. So you sell the building, you pay your commissions, you pay off your mortgage, you're left with some capital, you cut a check back to your investor, and your investor sort of closed that investment. And so that's what they're looking for, is saying, okay, over 10 years, I got a dividend every year that was based off the rents. After 5 years, I got a chunk of cash after we refinanced, and after 10 years, I got a larger chunk of capital back because we sold the building. And at the end of it, I started with X dollars and X, times 12% every year. That was a good investment. Sorry. So that would be, that gets fairly complicated, but that's, so what you're looking for, what investors are looking always for is the risk versus the return. And so, when you look at something like different investment products, and so this is a particular type of investment. So this is small scale, commercial, retail investment in Edmonton. It's very narrow in scope. Inherent in that, and the reason why, for example, you would have a higher expectation of return in that particular scope is because it's more risk and it's less liquid. So, you own this building, and 3 years down the road, you go, well, I actually want a bigger house in Palm Springs. Hey, Antoine, what's going on with this building? You're not just going to turn around and sell this building. Sometimes you might, sometimes you could, but more likely it's not like a stock where you can just phone your broker and the stock's liquid and you sell the stock. And so because it's less liquid, you need to see a higher return. And because it's,
Sorry, somebody asked.
what does liquid mean? Liquidity is how easy it is to buy and sell. So a stock is very liquid. I mean, if I own a stock, I can just sell it at any time. The price is set. It's very clear. There's very low transaction costs. It's easy to get in and out of a stock. It's much, much harder to get in and out of a small scale commercial asset. So that's part of it. And the other part would be diversification, sorry. So this, if you've got an investment, like we talked about in the Westmount building, it's going to be potentially more volatile. So if Edmonton does well or Edmonton does poorly, or if, the 124th Street area does well or does poorly, or that particular building does well or does poorly, versus, for example, let's say you had a REIT that has a bunch of properties. Well, that's going to be a lower expectation of return because you've now got less risk because you own a little bit of 100 buildings. So if a tenant goes bankrupt in one of your buildings, it doesn't really affect your returns on a holistic basis because you've got a little bit of 100 buildings. And so because you've got this, you've only got one building. If something goes wrong with that building, your investment, could go down quite a bit more than it would otherwise.
Yeah. Yeah, there's various sorts of debt that you might be more familiar with. And so these are kind of the ratios, right? You're going to the bank, 4 or 5%. They're first place on title. They're hedging their leverage. So they're saying we're not going to lend more than 70% loan to value. So if everything goes bad, we have a 30% buffer, right? The owner or the developer will lose their interest in the property, but the bank, at the end of the day, hopefully they'll be protected. So on that basis, they get paid first, they're secured against the property, and so therefore they're happy with a 4 to 5% return. Construction loans tend to be, sometimes you can get down to 6%, 6 to 10% for construction debt. Mezzanine, this is like, so if you want to come in and have, you don't have the 30%, and you want a second lender to provide some portion of that, they're going to come in at a higher interest rate. Actually, that can be up to 14, 15% in some cases. And so that puts into context the investor who's writing a check for equity, because they only get paid if there's profit, right? Like hopefully they'll get the principal back at least, but the building has to perform, and all these people have to get their money first before they see the return. And so that's where this 12 to 20% comes from. Now, if you have, it's a supply demand thing too. So if you have a really good investment product and you've built a great track record and people are inspired about the impact in the community, maybe gradually you can develop an investor base that is happy with 10% return, 8% return. And if you can achieve that, then you can flow those savings back down to all of your tenants. And so, but yeah, this puts it into context in terms of the capital resources and what it takes to attract capital to make a project possible.
Yeah, no, and that's exactly it. It's, so as I said, with the 5 years, so you hold it for 5 years and then you're going to sell it in 5 years. And so if that building has gone down in value, the Edmonton economy has gone down, and so it's gone down 30%, that means that you made $0. Like you get your capital back, but you've got no appreciation. The bank still saw their full amount back because they did 70% loan to value. So even though the property went down 30%, they still got their 70%. You didn't see anything back at the sale. I mean, you sold the building, the cash was left over, you paid off the bank, and then that was it. And so, inherent in all of this, and when we say 12%, it's like that's what you're anticipating, but because there's a chance that it doesn't go that way, you kind of have to give people more of a return if it does go well. So
the other thing to consider too is that there's like retail investment, and then there's the accredited investor market. And so it's true that for the average investor to find investments that are 12, 20% return, it might be challenging. But that's usually because they have small amounts to invest. And so their investments tend to go through brokerages and mutual funds and various types of bank products. So now you're dealing with all kinds of levels of management and administration that add to those costs. And so it'd be great if local developers could just work with the community who are happy to throw in small amounts of money and don't need a 12% return, because 12% is way better than anything that's available retail. But the challenge with that is now you're running into all the securities rules. So if you're trying to raise money and you're doing it in small amounts from the middle class of our communities, that's really, really expensive because of all the regulatory constraints. So the regulations are designed to protect the consumer from people who are unscrupulously raising money from investors who don't know how to think about investment and take risks, inappropriate risks. So the regulations are to protect that from happening, but it also creates a barrier to entry for investors to participate meaningfully in commercial assets in their own communities. And that's a design problem.
Yeah, that's a whole other thing that we're trying to solve.
But it adds to the equation here, because what it means is that you have a limited pool of investors to draw from. Either you have to create a platform and deal with all the securities compliance so that you can work with retail investors or smaller investors, which is expensive and onerous, or you're limited to raising capital from accredited investors. And the accredited investors have lots of options about where to put their capital. So that also is something that affects what capital is available and what the investors need to see to justify that investment.
You're talking about that guy with the house in Palm Springs. Is he what you would call an accredited investor, or is that like what a banker is?
I'm sure there are a lot of people with houses in Palm Springs who are not necessarily accredited investors. Oh, okay, sorry. Yeah,
So the question was, you're talking about the wealthy investors who are investing in some of your projects. Are they considered accredited investors in this model?
Okay, so the question is, are wealthy investors who are investing in our projects considered accredited investors? So accredited investor is a very specific definition under securities rules, and it has to do with certain minimum of cash assets or a minimum of total assets. I think these days it's $1 million in liquid assets or $5 million in total assets. If you have that asset base, or there's also an income test if you're making I think it's $300,000 per household now is the threshold. If you pass one of those tests and you're considered an accredited investor, then there's no regulation. You can invest in anything, and that doesn't need to be tracked or reported or anything like that. And then there's a whole bunch of other categories of how investment classes are defined in terms of the qualification of the investor, and then how you're allowed to communicate with them and how you're allowed to involve them in projects, right? And so things are evolving around this. There's a lot of interesting things. There's a lot of interesting dynamics with crowdsourcing, and now with like cryptocurrencies and blockchain. There's a lot of stuff moving in these areas. But yeah, just so that's if you want to understand where capital comes from that shapes our cities, it's valuable to have some orientation in what that market looks like. The various types of investors and the constraints and the regulatory limitations on who can participate and how. What's that? It absolutely shapes our cities. All of this shapes our cities. Like, for example, one of my good friends has a consolidated parcel of land on 99th Street, and they had developed drawings for this beautiful building with multifamily and a commercial podium. They didn't have a tenant leased up for that commercial podium because it was early in the project, and they needed to find out what kind of financing they could get. So when they went to the bank, this was about a year and a half ago, so Toronto, when Alberta is going through recession, they get scared of Alberta. So we see this every few years. The appetite for debt out of Toronto shifts every few years. But anyway, they went for financing, and the bank said, we're only going to give you 50% loan to value on the commercial part, and we'll give you 80% loan to value on the multifamily part. So that makes it difficult because that meant they needed another $4 or $5 million of investment capital to make the project go, which dilutes the return, right? If you add to the capital you have to put in, and the profit doesn't change at the end of the day, now you're just diluting the return on that money. So they pulled the commercial podium out, which, we might have been a bit more aggressive with making the commercial podium happen because we wouldn't do the project otherwise. But you can see how for most developers, that's an easy equation at the end of the day. When the bank says, we'll lend you 50% loan to value on this and 80% loan to value on this, most developers are going to say, let's just do it all multifamily and avoid the headaches. And so that shapes our cities. All of this shapes our cities.
And then we don't have the commercial amenities that bring the people, and there's no organic interactions, and there's no reason to be there. And there's no, you know what I mean?
Yeah.
Like all the things that you guys said at the start. And that got pulled out of that project because, you know, you go, hey, bank, only 50%. I'd love to pay you 45%. Now that you won't give me that money, I got to go to these guys who need 12 to 20. And the whole project doesn't make more money because of that. So you pull it out. So.
Yeah, and so like strategically from a city building perspective, these are important levers, right? Like I spoke at the beginning about this piece and the strength of the entrepreneurial ecosystem and how that influences to what extent really cool stuff can shape our city. Now we're talking about debt and equity and the capital resources and how the interest of those resources shapes our city. These are leverages. So these are levers. If we build up capital resources that are passionate about city building and are willing to take a little bit more of a risk and potentially a little bit of small return for the sake of having a stake in really cool, meaningful projects, we build that capital base, that will influence our city. If we invest in our entrepreneurial ecosystem and make entrepreneurs stronger, that will influence the shape of our city. These are like, when you get down to the fundamentals, these are the levers that have to be pulled. These are the gaps that need to be filled so we can have more brilliant, local, resilient innovation and culture.
Yeah, this is like a pretty deep dive. I mean, there's like
it's good. We have 3.5 hours.
A lot of stuff here, and like I said, I got a spreadsheet that I'll very like simple example. I dumped that spreadsheet and it still has like 100 data points, and you guys are gonna cross your eyes on it, but it'll start kind of showing you that there's a lot going on behind the scenes for a lot of this in terms of city building. Yes.
Yeah, well, so this is the question, right? The question becomes, what is it that you can impact as planners? Oh, okay, sorry. So the question was, advice as planners, what can be done to make it easier for developers to get the financing and to access the capital, and that's the question, right? So yes, so the question becomes, what can you have impact on? So there's stuff that is going to be within your job description that you can have impact on. And most of those have to do with what can you do to remove risk and not make things drag out. Because Jarrett's going to he'll get into some detail about the stuff that you guys control or influence that directly affects the risk profile of a project and can add costs by extending timelines. And these are very, very significant factors. And that increase the project cost, the total cost of getting the project done, right? And so when we're talking about cap rate before, and we're talking about value, so you do the developer has to do the math in the other direction, right? So they have to do the math and they have to say, well, we know what the net operating income is when we're buying it. We know approximately what we think we can achieve by improving the building and raising rents over time in terms of stabilized net operating income. But the question here is, what's the project cost going to be? So we're going to buy an asset, some land and building in a certain condition, and then we're going to put a bunch of money into the construction, and all those costs all together total the total project cost. And for that project to be viable, at the end of the day, that project, the net operating income has to be no less than the total project cost times 7%. So if we have a, let's say in this scenario, the $1 million property, if we buy a property for $800,000 and it costs $100,000 to get everything, the improvements and the permitting and all of that, then we had a total project cost of 900 grand. So we're exceeding a 7% cap rate. That project is viable. If we're in for $800,000 on the land and the building and we put in 100 grand and then we have our rezoning takes 24 months. In the meantime, we have interest costs that we're carrying, we're not generating any revenue. Maybe now it's a $1.2 million project. So now your cap rate is down to the 6%. This is not a viable project. So you influence those things as planners. And Jarrett will be able to illustrate some of this in real time.
Kind of. We'll see how the spreadsheet works. But, like an example would be, let's talk like the 99th Street project. So, you say, hey, I want commercial and podium, and you'll get 3 stories residential above it. They go to the bank, it doesn't work. And so then you as a planner could maybe step back and say, okay, well, what if we gave you an extra story of residential in exchange for that? Would that make a difference? Let's say, okay, you've got, you're in a multifamily building, you've got an amenity space requirement. And maybe that amenity space, wasn't going to be feasible for that type of product. You say, okay, we're going to take away the amenity space requirement, which means you can now get more revenue from the same amount of construction. Maybe that's what you need to do. And so, or you can say, at a high level, can we expedite all your permitting? So now you can get started sooner so that you've got to carry your debt for less time, which is going to lower your cost. I mean, there's little things you can do. Site servicing is a big one. We can, the city says, well, we were going to charge you $150,000 to upgrade the site servicing. We'll charge you $75,000, but you got to put this commercial podium in it. Maybe that's the lever that makes, and so there's all sorts of little things. Anytime you can reduce the amount of time it takes to go through the whole planning process, and then all the little levers that if you get a little bit more revenue, then you can maybe do something a little bit different. Or one area that, a little more revenue in the residential meant that now you can carry the commercial because you made a little more money in the residential.
But part of this too is like the value of being conversant, so that, because everybody's going to say, every developer is going to be, I'm not making any money on this project. Yeah.
So Antoine, that's kind of what I wrote down here. I was like, what kind of conversations do we have with an applicant to know that they're being reasonable, saying, we often hear, I can't make the project work.
Right.
Because they won't share the performance. That's probably a deeper dive. But will conversations like this, can they happen?
Well, yeah, they can, right? So this is difficult and nuanced, but the point is, at least you can have some orientation, right? Because there's certain data points that you can look at here that they don't even have to tell you. If you're familiar with the market, right? And it's incumbent, I think, upon planners to be familiar with the market in terms of what rents are in various types of properties. So we're going to play a little bit of a game later that will, kind of test your mettle in knowing lease rates in your market. But that's valuable, because if you're looking at a particular building and you have a general idea of what lease rates would be, and if you don't know, you can ask any commercial realtor you trust, and they can tell you, in this building, lease rates will be about X, right? And then you can easily do the math. You can just multiply the square footage by that lease rate. You're going to get your base rent is going to be your NOI. You divide the NOI by a prevailing cap rate. You can also ask a commercial realtor what a prevailing cap rate would be for that particular property in that particular location, because this can vary back and forth by 1%. So then you know the net operating income, you know the cap rate, and you know what the value at the end of the day should be for the project. And so then it's just a matter of, is the total value of the project at the end of the day more or less on par or above at least what the project cost is. And then you can be responsible, or at least sensitive to the impact you're having on the total project cost by the decisions you make as a developer. So whether that's affecting timelines or whether that's supporting an extra story in the building, then it's within the frame. You have a framework for viability, and you can evaluate whether the conversation is in that context. The other piece of that equation, though, is understanding the project cost, and that's a little bit more opaque, and that can vary pretty dramatically from one building to another. But at least you have some orientation. You can have some sophistication in your conversation with the developer. And in other cities, they actually build this capacity in their planning departments. So I know that Vancouver has a program where you have to provide your pro forma, and the city does their own underwriting, so that they're not going to get the wool pulled over their eyes, but also so that they can support developers and be creative when the pro forma is actually stressed by something that the planning department is impacting, right? I know that there's issues with that too. It's not a perfect solution to this problem, but it's just interesting to see how different cities deal with this question. And so what I was saying earlier is that, to answer your question, there's two things, right? There's what you can do inside of your role as a planner. And the first part of that is just getting educated. Like, this is really, it's relatively simple when you get down to it. Getting a grasp of this and owning these metrics, right? Know the metrics. But the other thing is about leadership. And if you think about your role as a planner and you think about your voice in the city, and if you're aware that what's really constraining, the really cool stuff, it's not just this function of like having a design committee make sure it looks cool. It's a function of the project has to be viable, but also there's the debt and the entrepreneurial ecosystem. And these are important drivers that influence the kinds of outcomes you want to create through your planning work. So what can be done there, that's out of scope with your job. It depends how passionate you are and how good you are at building relationships and influencing people and getting clear and articulating your imagination around what's possible to make the city better. All right, are we good on time? Okay, so we're going to take a little bit of break. When we come back, we're going to play a game, and we're going to need some volunteers. So you guys can warm up during the break.
About 10 minutes. We'll come back in 10 minutes.
All right. What's your name? Riley. Riley, you're the next contestant. Yep. 3 more. We're not going anywhere to those 4 people in these seats.
We'll just keep playing the music.
All right. Riley and Kate. Riley and Kate. Kate, welcome. What is it again?
Yay, Colton.
Colton? Colton. Riley, Kate, Colton, and Josephine. Riley, Kate, Colton, Josephine. You guys, you're neon green, you're baby blue, canary yellow, fuchsia. All right. Okay, so this is base rent, lease rate, Price is Right. So this is like, if you start to get a bit familiar with what base lease rates are in various neighborhoods in the city, you can just walk around the city and be like, that building's worth that much, that building's worth that much, that building's worth that much. You have to guess the square footage, but so the base rent lease rate is on a per square foot basis. Okay, so when we're going to rent a building, so this numbers I gave you for Westmount, for example, this is $120,000. So this is about a 15,000 square foot building. We've got some retail, we've got some office. So this is like your cheat reference. Okay, so in this particular building, the ground floor retail on 107th Avenue and 123rd Street. So consider the location, just a block off 124th Street. 124th Street's high demand. We're like close to it, but not quite on it. 107th Avenue has some security issues, vagrancy issues, some break-ins. We have break-ins in this building. We have security cameras we have to set up. So it's like not quite 124th Street, but close. And so in that location, this ground floor retail typically rents for $18 per square foot, $20 per square foot, right? Now, I know, right? I lived in Europe for 10 years and came back and was like, what? You guys are still using the Americans' numbers? Anyway, so per square foot, and that's on an annual basis. Okay, so if you have a 18,000 square foot space and you have 1,000 square feet, right, at $18 per square foot, that's $18,000 per year will be your base rent. So it doesn't include your op costs, that's just your base rent. So that'd be about $1,500 a month is what you pay in base rent. Typically on a building like that, the operating costs will be somewhere between $8 and $12 per square foot. So that'll be another $12,000 per year. So your total gross rent would be $30,000 per year, but the base rent would be $18,000. Okay? So base rent per square foot times square footage gives you your annual base rent. So $18 is the Westmount building for the ground floor. For the office upstairs, it's $10 to $12 per square foot. Okay, so that's just a reference point for you guys. All right. Okay, so we're gonna go through 4 properties. This is the first one. You can turn around. It's a little awkward, but you're flexible. So your job is that space that's highlighted in red. What would be the square foot? This is on Jasper Avenue. So this is just off 104th Street, just east of 104th Street. So right, that's This was the old Firmus building. This is like this. Now I know why Barb Barker's like describing all these projects while they're guessing the numbers. So, and then right next door to that skinny little undeveloped building on the left, there's the Burks building. So this is right on the corner of Jasper and 104.
Tomcat Shoes was there.
Yep.
Oh, okay. Well, Shoes there, and then we book in. So if you look on the other side, we book in on the other side. So that's
Okay. It's also another little detail. It's a bit of a weird space. So if you go in there, it's long and skinny, and it hooks around the back. So like it opens up in the back. So it's a little bit awkward. Like some part of it is street frontage, some part of it is kind of hidden without any windows in the back. But anyway, so let's give you a bit of an idea. So you're gonna be asking like, what are Jasper Avenue rates? What are downtown rates? Approximately, what would be a square footage rate for this place? Okay, you guys ready? No? Okay, we'll give you a couple minutes. You just write down the dollar amount in big, the dollar amount per square foot, and you're gonna flip it over. Don't cheat. All at the same time. Yeah, exactly. Closest bid without going over. That's what it is. Yeah. And so and then we're gonna have a. We're doing a showdown.
Yeah, we'll have a couple of rounds.
Okay. All right, you can play the music while they're doing this, just to inspire them. All right. Okay, I think we got our bids in. So on the count of three, everyone turn your cards over. 1, 2, 3. All right, $26 a square foot. Riley, Kate, $23 a square foot. Colton, 31. Josephine, 37.5. What do we got? What's the rate on this one?
It's for lease right now. You could lease this out for $19.75. So my price is right cool.
No one gets
Somebody should have put $1 in.
That was a tricky one, Jared. That was mean. That's a really low rate for Jasper Avenue. But it's been for lease for a long time, and so that has a little bit to do. I guess it doesn't show the floor plan in the brochure, right? Yeah.
So that's.
It has a little bit to do with that. Maybe there's some issue. Maybe there's some. I don't know. That's a low rate, and that is vacant for a long time. Okay. Bum. All right. What was our lowest bid on that? 23. Okay. All right. Well, we start you off with a trick question. Good. Yeah, because these are actually, even these are pretty, like if this was a fully developed building on Jasper, we'd be looking at base rent starting around $30. Yeah. Jasper typically tends to be $30 to $50 base rent per square foot, depending on the product. I'm on, right? I'm good? Okay. All right. Property number 2, White Avenue. This is 104th Street? 109th Street? No, 105th. 105th Street. Calgary Trail. Right? So Calgary Trail and White Avenue. It's also been vacant for a while. I think now that's tenanted up. I think they have a lease on there. That's right. There used to be a lot of stuff in there. This building's gone through a lot of different uses. Okay. So come up to your lease rates. A little music. We got the Dairy Queen going next door. We've got. I know. Yeah. No, it was a chocolate place. You're one block away from all the fridge grounds, all the art farms and Costona. I think so, right? Is this to the west? Yeah. This is the southwest corner. Yeah. Okay. Maybe. Yeah. Okay. Sure.
Ready?
We got still some writing going on. Ready? 1, 2, 3. 34. Riley's got 34. Kate's got 27. Colton's got 46. And Josephine has $25 per square foot.
5 on the main floor,
Bam.
5 on the second.
Bam. Okay, well, I guess we're mainly looking at main floor. So what do we got? 34. All right, Riley, right under the wire there. Excellent. Okay, so who is the? So we've got you were closest on the first one, right? Yeah. All right, Kate and Riley. All right. Third property. You guys starting to get a feel a little bit? Oh, this is also a bit of a tricky one. So this one is lower than you would probably expect. I'll just say that. I think the reason is the landlord. I think the rate here is they don't want to put any tenant improvements in. So this is something to consider too, right? When you're a tenant and you're going into a building and you're negotiating a lease, there's whatever the average market rate would be for that space, but there's a few other levers. So typically when you sign a commercial lease, the landlord is going to agree to invest with you in the improvements you're putting into the space, right? And that's typically on a per square footage basis. So, the landlord might agree to put in $20 per square foot. So if you're going to have to spend $80 per square foot to fit out your tenant improvements in the space, like putting in flooring and putting in walls where they need to go, countertops, whatever, then if you're going to spend $80 per square foot, the landlord will cover a quarter of that, right? So that's an important negotiating point. If the landlord refuses to put any money at all into the improvements, then the tenant might ask for a lower lease rate. And so they influence each other. Yeah, this brick building, it's all fitted out with offices inside. This is on 105th Street and 103rd Avenue. Or, yeah, 105th Street, 102nd Avenue. 102nd Avenue, right. So just at the end of this block, so we've got
Character's Restaurant, I think, shares the building. Is that Character? Is that the one with Character's
south? To the south. And yeah, so 104th is right around the corner, and you've got the YMCA
to the south, like
no, the YMCA is south.
Yeah, if you go south, then you get to the Yellowhead Brewery and the YMCA.
This is the Japanese Village. It's just 103, right? It's 103.
This?
103, 103rd Avenue, 105th Street. Yeah.
Oh, so the brochure might be wrong. The brochure says 102. Yeah, the brochure is wrong.
Yeah.
Oh, yeah. Wow.
Yeah, the Japanese Village is there right around the corner. That's right. Yeah, because 102 would be the metals building on the corner. This is not.
Yeah.
All right. You guys ready?
Lower than you expect.
1, 2, 3. All right. Riley's got $25. Kate has 15. Colton has $13.75. Very precise. That's good. And Josephine has $22.50. Okay.
All right.
All right.
This could be leased out for $12 on the main level.
$12.
$8 in the basement.
Anybody want to open an office on 103rd Avenue? Yeah. Yeah, it's very low. It's very low. Yeah. And it's also been vacant for a while. So again,
yeah. That's $12 is not much. So something's going on there.
We just want to get you up here and pull the rug out from under you.
give you a foundation and then show that you can't, nothing can be trusted.
Yeah.
So
okay, last one, Hull Block. So this is 97th Street, Chinatown. Beautifully restored heritage building. This was Next Architecture, was involved with the redevelopment of this. Quite nicely done. It's residential upstairs, so we're talking mainly about the main floor. What do we have down there? Skateboard shop and
the tattoo place.
Tattoo and skate shop. Yeah. All right. Yeah. Yeah. If we were talking about retail, like cannabis distributors rates, it just throws everything out to lunch. They pay way more than anybody else would pay. Yeah, double, triple. All right, ready? So we got some bids coming in. And 1, 2, 3. All right, Riley at 27 bucks. Kate at 20. Colton at 9.80. Josephine at $1. Awesome. You know how this game is played.
All right. So this is the main floor right there. So this one's interesting because there are 4 different rates on that main floor with the different tenants. I don't remember which ones were the.
So our
skateboard
average
shop.
is $18.80.
Yeah.
$18.80. Where we got? 27, 20. I think Josephine takes the cake. Oh no, 9.80. 9.80. All right, Colton's got it. Bam.
Good
job.
All right, that's 4. Who got the third one? You got. It was.
Colton, because he had 1375 and it was 12.
Yeah, that's right. Good. All right. Well, I don't know. Is that it, or is there like a final round?
Round of applause.
Round of applause. All right. Well done. Thank you. So when you're not totally sure about your best guess on rate, just have a commercial realtor in your pocket and call them and say, hey, what do you think this building's worth? And they'll be like, "Ma," and who can give you a number, or she. So. All right. Now we're going to get into spreadsheets. Yeah. The cannabis scenario, they're literally bidding 2, 3, 4 times market value for base rents to secure their places. So if the rent's $18, they'll pay $36. They'll pay $50. I've seen some cannabis leases in the last couple months at $100 a foot in $30 space. Yeah. It's interesting.
All right, so this is sort of the next phase, and I think my mic's working, everything. So this is sort of my attempt to sort of distill down some of the principles and show you maybe how it would work, so we would, when we look at a project and we underwrite a project, sort of it's a multi-stage thing. So the first thing you do, and you guys saw those brochures, we get sent those brochures all the time. You do your quick back in the napkin, which looks a little bit like this, which is, what are the lease rates? What are the potential lease rates? What are you buying it for? That kind of thing. And that'll give you a sense of the project. But to actually go through and raise capital and buy a building, you really need to sort of drive the underwriting. So this, I hope, isn't going to get too messy. But what I did yesterday was I took an example project and I built this out. So this was a, buy a piece of land, hold it for a few months, build a building, and then hold a building, and 5 years later sell the building. And so, what I'm going to attempt to kind of show everybody is taking some of, our conversations on lease rates, on financing and construction, and maybe how some of this all works. There's going to be a lot of stuff up here, so I'm going to try to go slow. We've got about an hour, and see if I can sort of, the best I can, show you how this would work in sort of the practical sense. So I guess I'll just sort of start off with, how this would work in practice. So this spreadsheet here, and I'm gonna have to zoom in so people can see it. How do I zoom in? Can everyone see that? Is that? Yeah, no? Okay. So in this particular project, we've got a series of things that'll happen. So with each one of these, what you're going to see is a whole bunch of numbers that'll go in and out. So think of this as sort of your bank account. So you buy a building in July of 2018. So at the top of the spreadsheet, we've got revenue. So in this particular example, we're building from scratch. There's nothing there. We bought a piece of land. So we've got nothing coming in. There's all sorts of little things that, you might pay for. So, you've got, something as small as a bank fee. We would model this out. This is really diving into the details. At a high level, you don't need to know that. But let's say we're going to buy some land. So coming out of our bank account, we've got $1.5 million. Coming out of our bank account, we've got due diligence costs. So when you go to buy a piece of land, you need to usually get like an environmental assessment done on it. You might have some cost consulting done where you say, okay, I'm going to build a building. It's going to have these parameters. I am not going to hire a construction company to fully price this out, but I need to have an idea of where it's at. You do your environmentals. You might have to do an appraisal to get lending from a bank. There's a few costs that'll go into this. You buy land. You might have to pay some property taxes once you own the land, and that's pretty much what your outflows go. And then you're going to have to get a loan. So this is an example where I'm going to show you sort of one scenario, but in a lot of this, there's going to be a bunch of different things you could do. So, if you were to buy that piece of land for $1.5 million, and you could pay cash, and if you paid cash for it, then you wouldn't have a loan on it. But in this particular case, I said, well, we're going to loan the money, so we're going to have some fees on taking a loan, which takes us down to, so we need to come up with, just over $1 million, $1.543 million. That's going to help us, buy the land, pay for the due diligence, pay for the cost of getting a loan. And so we need to get some money for that. So we've got, I've got, financing, again, gets into a lot of different tranches. There's a lot of different ways to do this. In this particular example, we're going to borrow some money to buy the land. That's a pretty simple transaction. We're going to borrow $1.7 million. The reason we do that is that when we look at our cash flow every month we're going to have costs. So every month we're going to have to, so this is when I'm sitting in meetings with the planners. I'm going, hey, I want to build this building. I own this piece of land. It's just sitting there. I got to still pay my property taxes. I still have to pay interest on the loan that I took to buy the land. And this, it got brought up earlier. This is where, when you're in meetings with developers or, folks that are trying to do projects and they're trying to get you to hurry up and like, I need these approvals and I want to, it's because every single month, you've got this number. So every single month in this particular scenario, I got to spend $16,000 on property taxes and interest. Sometimes there's additional costs. There might be security depending on the land. There's some other stuff that could go on, but usually every month you're paying money. So, you're there and the guy's going, you go, hey, it's going to be another month. And, come on, it's because he's got to pay an extra $16,000 in this particular example. So obviously the land is more. It could be offset by holding costs. So if the land is in the quarters and he's got a gravel surface parking lot on there, he might not have any urgency because this number might be positive because every month it's like, yeah, I'm paying property taxes and I might pay interest on the loan. But this gravel surface parking lot that is unpermitted when they're in the quarters is cash flowing, and so it's not that urgent. I can sit on it. So, but in my example, this is something that there is nothing on there, so we're paying every month. So that's why there's a little urgency to get something done. So because we have to pay every month, and because we're going to spend 6 months dealing with the planners to get everything set up, 6 months is very ambitious. But in this project, we're spending 6 months. We can see that there's, up there all the way to the end of December, from July to December. So we're going to borrow $1.7 million, which is going to cover the $1.543 million that we spent on the purchase and the due diligence, and it's going to cover 6 months of my property taxes and my interest. So that's, one of the levers that can get pulled. And so then, so now I'm going to build a building. And so how does that affect what's going to happen on my cash flow? So again, now we're into construction. So I've got a 1-year construction period. So this goes from January 2019 to December of 2019. And that is a 1-year construction project. That's pretty quick, starting from vacant land. So sometimes these timelines are this is an example, like I mentioned. So in this case, you've got some costs that are going to come out of your project. You've got property taxes. So that's, again, let's say that there's a lever that you think you could pull as a municipality. There are examples of municipalities that do property tax holidays. So they know that, there might be a particular piece of land. This is hard. I'm the developer. I'm paying every month. and they'll say, well, we really want this to be developed, so we're going to give you a property tax holiday, which means that I've now got money that was coming out that is no longer coming out. And as I'll show you guys as it flows through, that's going to help make my project have a higher return, and it might be the difference between the threshold that I can get investment and the threshold that I can't. The other things that will affect this on the land standpoint that affects planners are offsite improvement costs. So I've got my land, I'm going to build my building, and the city comes back and says, well, we need a 6-inch water line. There's only a 4-inch water line. And so it's going to be, you're going to have to cut a check to EPCOR for $150,000 to upgrade that. So I've put $150,000 in there. So part of the way through the construction project, as I'm building this building, I've got $150,000. Sometimes there's other offsite improvement costs, or there's sometimes offsets. So sometimes you'll see municipalities cover some of that. In my example, I don't have that, but that would just be putting a number in there saying that when I wrote the check for $150,000, I could put a positive number in there for $50,000. Maybe that was what the city said. We'll cover $50,000 of that. Without going into too much detail, I'll show you a little bit about how some of the other flows happen on a construction project and some of the stuff you're paying for. You're going to pay for your permits and fees. This is your development permit. This is your building permits. These are any other fees that you've got. I've got $40,000. I'm paying that up front. You're going to pay for your design and engineering consultants. So these are your architects. These are your mechanical subtrades. These are your electrical subtrades. These are the folks that are really going to show how your building's all going to work, and they're going to charge you. Usually, it's on a percentage basis for the particular project. You're usually going to have a development management fee out of the project. This would be what you're going to pay for the folks that are doing all the work. So as an investor, this would be, when you think about our company, for example, that would be the fee that we would use to then pay our staff and our salaries. And then it would come out of the project that the investor owns. You got things like miscellaneous, you've got construction, and you've got contingency. And that'll build up sort of how you look at a construction cost. If you want to look just real quick on how a construction budget looks, it can get very complicated. This is often the nut you've got to crack as a developer trying to bring a construction cost. So you've got a bunch of different divisions. Within each of these divisions, you're going to have a bunch of different choices and things you can look at. So if you see here, for example, Division 19 mechanical, that would be, there's a whole bunch of different things you can do in this particular division that's going to affect the performa of your building. So, you can get a bunch of furnaces. So I'll use the example, the Gibbard block. The Gibbard block that we're redeveloping right now, it's got an old boiler from 1912. It's this huge, massive thing. It's like 10 feet by 5 feet. And so we're going to put a new mechanical system in. And so now you're looking at all your different systems, and you can put a bunch of furnaces in there, and it's going to, be fairly expensive to run. It's going to be electricity, but furnaces are cheap. It's like, okay, well, what's the next step? And so then you say, okay, well, we're going to get a boiler in there, and we're going to have a boiler that's going to be pumping water through, and that's a little bit more expensive. And so one of the games that you play as a developer is knowing that, you're going to set a certain budget at the start of a project, and then you're going to have to try to make decisions often within all these different categories to get yourself to the same budget. In this case, I've got a $2.2 million construction budget, which works out to $145 per square foot. And so that's how construction is affected. So if we go back to our monthly timelines, we've got that number right there. So that's how we're going to pay. So over the construction period, 1 year, every month, we've got to pay $190,000. Of course, in the real world, they aren't an even flow. You kind of pay as you pay your subtrade. So 1 month you might pay a little more because that's when you had to order your boiler. The next month you pay a little bit less because that particular month the stuff that you had going on site was your rough carpentry or something like that. So you got a bunch of flows out, and then you've got contingency, which is just a catch-all that you often put in a pro forma. One of the principles that you use when you're looking at a project and underwriting it is you're trying to be conservative. So even if you think that you can build a building for $2.25 million, you should probably plan for, in my case, a 5% contingency. So you take the whole total price, you add it by 5%, so that if something goes sideways, you get into the building, or you're building the building, and all of a sudden you realize that the electrical system that you wanted to serve the tenants needs to be a little bit more expensive than you had budgeted, your performance is still going to work. It's always better to go back to an investor at the end of a project and say, hey, I know that we said, it's 2.2 and we put another $112,000 in this case. We didn't use the 112. It ended up being the 2.2. We were good estimators. It meant the project worked better. It's better to do that for an investor than to come back and say, we thought it was going to be 2.2, but then it went over. And so now the project didn't perform as well. So a lot of what you do when you build out a pro forma is you're going to be conservative in how you do your estimates. So we've got the money coming out, and then, so that's how you look at it from a construction standpoint on the actual hard costs that are coming out. And now you've got your financing. So as I said, so you bought the building, or you bought the land for $1.5 million. You took a loan out on that. The loan then, you use that for 6 months, and then you take that loan out with a construction loan. So the construction loan would be, you bought the land for this much, you're going to build this much for construction, and in this case, there's going to be different types of loans. Sometimes you'll use 2 different types of debt. Sometimes you'll use 3 different types of debt. It gets very complicated. I'm just using a case study. So in this case, we're going to take the land loan that we took. We're going to pay that off, and we're going to take another loan out. So that's where we see this. So that's money out of our bank to pay off the loan, but then we get money in on a construction loan, and then every month after that, the construction loan, you draw money from the construction loan so that your project can keep money in your bank account. All of this flows down, and you'll see that, so every month you're going to spend money, and then every month you're going to take a draw from a mortgage, and that you've got a cash balance. This is the amount of money that's in your bank account. So you take, in January 2019, the first month of construction, we spent $305,000 on construction. We paid back a loan that we had for the land, but we took out a bigger loan for the construction, and that we started with this much cash, and we ended with this much cash after we added all that up. All of that gets somewhat complicated, and I can send the spreadsheet around afterwards if you guys want to take a look at it. So then, so you go through your construction costs, your construction period, you spend all the money that you had on your design and engineering consultants, you spend the money that you had on your development management fees, you spend the money that you had for your hard construction costs. You then get to the end of the project. 1 year later, it's now December 2019, and you hand the keys over to your tenants. So your tenants now have a couple months where they're going to go through and they're going to upgrade their buildings. Antoine mentioned earlier that often what developers will do is provide a tenant improvement allowance. And so as a developer, this is when you're going to cut a check to your tenants. And this is where you're going, so the construction's done. And so we have offered, in this case, and I'll show you guys where this came from, $310,000 to our tenants. So this is where they've gone in and they've put in their, they've got a restaurant. So they're putting in kitchens and millwork, and it's quite expensive to run a kitchen. We're going to help them offset some of that. That was part of the lease negotiations in this case. We've also got leasing commissions. So that would be when you see the brochures that I brought up earlier from Cushman Wakefield, from Royal Park Realty and Colliers and all these guys. That's how they get paid. So they bring you a lease and they say this restaurant is going to take a lease, but because we brought the lease, we need to pay you guys, and that's often a function of the amount of money that you're going to see over, let's say, a 10-year period, and there's a formula for how lease fees are calculated, but it's usually 5% of the value of the first 5 years, 2% of the next 5 years on an option, and I can show you guys that in a second. So you're going to, so you've got this 2-month period where your tenants are in there. Under our construction section, we've got nothing going on. We've already built this building. We still have a loan, so we're still paying interest on the loan, but we're paying our tenant improvement allowance, and we're paying our leasing commissions, and that's sort of how our cash flows down. So now our tenants are in there, and this is what's known as the stabilization period. So there's a period of time where construction's finished, tenants are done, and this is operating. So this is when you guys are all there. You're all coming to the new restaurant, and this is this new restaurant in this new building, and this is fantastic. This is known as the stabilization period. So the stabilization period is sort of where this is where you work the kinks out. This is where you're still, as a developer, fairly involved. It's like, hey, why doesn't, this work? Or let's make some changes, or let's bring our trades in. The mechanical doesn't work quite as we thought. Your trade comes in and says, oh, well, we just got to adjust the settings, and let's learn how to do that. What's exciting about this part is that if we go up to the top of the spreadsheet, this is where we start seeing rent come in. So we've got our building, we've got 4 bays. They're all, with lease revenue, and you're going to see lease revenue every month. So now you start seeing a positive number. So every time you see on the spreadsheet, these are negative numbers. If you see too many negative numbers, you've got a bad project. So we start seeing some positive numbers. We still maintain our financing, so we still have construction financing, but we're not taking anything out on the construction financing. And so we get to 4 months later, and now we say, okay, so the building is stabilized, and so now we're going to take out our construction financing. We're going to pay that back. We're going to take what's known as a takeout loan, which is a lower interest 5-year loan. To get those, these are from a bank. They want to see stable lease rates. Your leases are in place. Your construction costs have already been set. There's much less risks. You get a much lower interest rate, and so from there on, so you pay back your construction loan. So that brings that down to 0. You take out a loan, and if you see this takeout loan, there's a big formula here. I don't know if you guys can see that, but basically the amount of money that the bank will give you. We mentioned 70% loan to value. If you can see there, it's a really small number, 0.7. So you basically say, what's the value of the building times 0.7? That's basically the loan you can get. And so from there, then you go into sort of operations, and operations sits here. As you can see, you've got revenue coming in every month. So the NOI that we spoke of earlier is, when we speak of NOI as an annual rate, this is how it works in the real world, I guess, sort of thing. So yeah, I guess why don't I follow it through, and then we'll jump back and we can sort of ask questions on how each of the sort of stages work. So when we spoke about NOI, what this means is, in this case, if we go to our assumptions and notes, Bay 1, let's say it's the basement. It's not a good rate for a basement, but anyways, it was 3,000 square feet, and we had $25 a square foot. And so that means that each month, the person that's in that bay cuts a check to the landlord for $6,250. And so we've simplified it a little bit because there would be operating costs. Antoine mentioned earlier, a commercial tenant pays for property taxes and property management on the building and any repairs that need to get done. But because that's an in and out, I'm just going to ignore it for this calculation. But if you wanted to fully build this out, there would be an in and out where you're also paying expenses, but then your tenants are paying you back. And so it might not work out every month, but at the end of the year, it works out so that the net is you get $6,250 from a tenant each month. You've got a small amount of costs that you might pay as a building owner for different things that'll happen. You've got bookkeeping, you've got bank fees, are pretty minimal. Yeah, sorry, these are non-recoverable. So there are recoverable expenses that you bill back to your tenants. There are some expenses that you don't get a bill back to your tenants because the way the commercial leases work. And so then you do have to pay a little bit every month. And so you end up with positive cash flow from your operations. There's nothing going on construction, building's already built. And so really the only thing you've got to worry about is your take loan payment. So this is a payment that you pay every month on your loan. That's basic calculation that you go, what is the value of the loan that we took out? What are we going to amortize it over? In this case, it's 25 years. And what are we going to pay on interest rate? In this case, we've got 4.95%, which is about competitive on a takeout loan. And so then once the building's stabilized, the calculation is fairly simple. You've got a little bit of money coming out of for a loan. You've got lease revenue. You've got a payment to your bank, and you've got a few non-recoverable expenses. So every month you get a little bit of cash. And so this is where the building just sort of, as the owner, as the investor, nothing much happens, or not that much happens on a month-to-month basis, hopefully. I mean, this is where if all your tenants their business is doing well, your building doesn't have any major repairs needed, it's like, what goes on in a month isn't much. Of course, if there's a lease that's expiring, or there's a repair that needs to happen, or, there's just conflicts between the tenants because somebody's using a parking stall that wasn't there. I mean, there's little things like that, but it's, most of the work from our standpoint happens in the colored area where there's construction happening and there's a lot more moving parts, as you can tell. So then, we sit here and we hold this building for month after month, staying pretty stable. You might have a lease escalation, so every year the lease rate goes up. So, there's a 2% escalation, so it went from 25, and it goes from 25 times 2%, and then it goes to 25, 75, or whatever it is. It stays pretty stable. And in this particular case, then at the end of it, 5 years later, we say, okay, we're going to sell the building. So we sell it in, at the end of December 2024. So we are going to see an amount from that building. This is back where now it matters what the cap rates and the income is. And this is back to sort of the simple calculation where what was the net income at the time we're going to sell it, and what was the cap rate. And so this is a formula that's driven. So we basically say, what is the net income over the last 12 months? That's what this formula is. So you just take 12 months of income, you multiply it by a cap rate, which I've put over here. So we say in this case 6.5%. You sell the building, you pay off your loans, and you're left with some cash at the end of it, and that cash goes back to the investors, and the project's done. So that's sort of the life cycle of a development project. Now, you don't have to sell it after 5 years. I mean, you could hold this for 50 years, and every, month you get increasing revenue, hopefully. And so maybe after 5 years, you'd have to renew your mortgage. And so that's where you would go to the bank. You would say, okay, so now my building's worth this much. And they'll go, okay, 70% of that much. This is how much money you have, which you used to pay your previous mortgage. And you might be left with some cash, which would turn into a dividend for your investor. So that all flows back to an annual. So I've taken all of that and I've done annual. So these are all the cash flows that happen on an annual basis, which is basically just taking the spreadsheet I just showed where it was monthly, putting them into 12-month chunks. This all flows down to how much cash was coming out of the project. What you see here is this bottom line. We put $1.5 million into the project. In the first 3 years, the next 3 years of the project, we received $80,000 a year in a dividend. And then when it was all said and done, we received a $2 million dividend when we sold the building. And that gives us an 8.4%. So I'd have to go play around with the building. That would be a tough one to get an investor on. But there's a lot of different levers that you could play with that show how this all works. So at a very high level, I hope I didn't lose you guys. That's sort of how the flows work. You've got money coming in, you've got money coming out, and that at the end of it, for an investor, and what we're trying to do as developers is have all the ins and outs over a long period of time, bring back to an IRR that is investable. So what this is saying is that if you had taken all the money you received and invested it as you receive the dividends, at the end of the project, you would receive an annual return of 8.4% on your investment, which still might be pretty good for some investors, and maybe you can make sense of this particular project with this particular set of parameters.
But getting to Kate's question from earlier, see, this is where it's interesting because this is at 8% right now. And it's like, okay, well, 8% IRR, that's a compounding return. That's a pretty good return. But if you consider the risk variables in this project and you think, well, what if your construction costs go 10% over budget, right? So now that 8% becomes a 5%. So that's, these ratios are in the context of risk. And it's pretty easy to move that IRR quite a lot if costs escalate in the project, right? Or if you don't get the lease rates you're anticipating, or if you end up with a big vacancy for 6 months. These are all things that significantly impact this return. And so there's a lot of risk that's reflected in that number. Cool.
I mean, an example would be you mess up the application, it could be the applicant, whatever, it goes sideways, it takes another year. You have all those year of carrying costs.
Yeah, that's right. You have the whole year of carrying costs. You have, you may have, like, you put the effort in to mobilize the tenants to activate that space. They all have their own timelines, right? So if your project gets delayed by a year, you might have tenants ready to go who fall off the wagon. You know, these are all significant risk factors. So the carrying costs are a big one that are like, there's no way getting around that. And then there's all the other potential repercussions, right? Sometimes it's also the debt, right? Like you might have signed a term sheet, or you might have a lender who's willing to commit, and then that year goes by and the price of oil drops by 20 bucks. Now that you've lost your lender, you have to start again with that process. You have all of your, a whole bunch of reporting work that you do. So your appraisal, your environmental site inspection, that's in the 5-6 digits in cost depending on the scale of the project. And the banks want something that's recent. So they want 3 months old, 6 months old. If your project gets extended by a year, you have to incur all those costs again, or pay to have them updated. So everything increments in that as your project costs as timelines get stretched out. And then consider also the impact of an extra year on the return to the investor. Right? So if you invest $1 million and you want to earn 10, here in this case, if you agree to invest at an 8.4% IRR, and then that whole first year your IRR is 0 because nothing happened, that is going to massively impact this number. Yeah. Even without any extra costs, just having a year with 0 return to the investor. So if every project you do has these kind of problems that were unanticipated, then the investors are going to say, we shouldn't invest in Edmonton because we always have these extended, unpredictable delays.
Yeah, I just have a question regarding where the investors come in this sheet. So, like I noticed you have your opening land loan, and then you have your construction costs, which I'm not sure, but construction as well. So that initial investment from the investors, where is that money? Like, where is that in this spreadsheet? You're talking about the loans and whatnot. So are you counting the investment from the investors as a loan?
Yeah. So the question is where do the investors come in? And so again, to try to simplify it in this particular case, I assume that we were going to borrow 100% of the value of the land and 100% of the construction cost. In reality, there would be equity required at both of those stages likely, which makes this a little bit more complicated. So I assume that while you held the land, you would have 100% loan and you would just be paying interest. While you are doing construction, you'd have 100% loan, you would just pay the interest. And so then where the equity comes in is, as I mentioned, after the stabilization period, when we've got a building, we're going to go to a bank, they're going to give us a takeout loan. That takeout loan is going to be based on the value of the leases times the cap rate times, call it 70%. And so then in this case, 3.7. To build this whole building, we needed, to buy the land and build the building, we needed $4.7 million. And so then we see here, it's called a shareholder's loan. So this could be considered a shareholder loan or equity. So this would basically be, at stabilization, I would have to go and get an investor and say, I've got a $4.7 million construction loan, that construction and land loan. This is what everything I had to put into the building. The bank will give me $3.7 million. So I need to come up with $1.6 million of equity. And so equity can also get treated as a shareholder's loan, and that's for tax purposes. So you're not going to pay taxes when I return that money. So if I give you a dividend, it's not actually a dividend. So let's say you give me, so we do stabilization. So we needed $1.6 million into the project. And then after a year, we've got extra cash in the bank because every year we're cash flowing. So we say we're going to send a check to the investor who gave us $1.6 million for $50,000. That money is a repayment of a loan from a tax standpoint, not an actual dividend. And that's why I've classified it as a shareholder's loan, not equity, but they basically operate the same. So that's where it came into in this project. So then you can see here that this is the closing shareholder's loan balance. So this is basically your closing equity. And that, you know, December of that year, you paid out $50,000. So now you've got a loan of this much, of 157. The next December, there was a little more cash. So you paid out $80,000. That brings your loan balance down. And that goes all the way to the end. And what you do at the end is you pay back all of the loan to the shareholder. And so if we go and figure out the calculation from the shareholder, in this year here, the shareholder, I'm going to do a formula error. Yeah, that should be right there. No, that might not. Hold on. I was like, I'm building a model. I'm going to put it up in front of everybody. So anyway, so this would come in there. So that would be considered a cash flow back when you're calculating the IRR is just the repayment of the loan. And so then from a tax standpoint, you're not actually paying any taxes on that part of the return. So once you've sold the building, you paid off your loans, and your bank still has money in it, part of the distribution back to your investor would be just paying them back for the money that they put in the project initially. You don't pay any taxes on that. That's not considered a dividend. And then anything that's left over that would be over and above that would be considered a dividend, and now you got to pay taxes on it. So that's sort of how that flows.
And you can keep in mind too that all of this is taxed at about a 40% rate.
Yeah.
So is there kind of a sweet spot in terms of the length of this? Like, ideally, this model shows 10 years, you're investing much money into the building. Is there a scenario where you hold on to it for 15, 20, 30, and then pulling it outright?
It depends on what's more important to the owners, right? Like whether you're investing to maximize RIRR, or if you're an investor who just has a lot of money that needs to be put somewhere and put to use, then you might just want to allow the principal to pay down and the whole asset to deleverage over time. So, but from our perspective, like the ratio of if you just build something to sell it, kind of flip it, often it's a different kind of incentive from a development role. Like you're not investing for the long term in that neighborhood. And so you may not have as much motivation to design for the long term benefit of the neighborhood. You're more looking for a product that will sell quickly, and then you're out of the neighborhood. So it doesn't matter 15, 20 years down the road what the relationship is between that building and the neighborhood. So we find that developers who build buildings to own them for a long time often tend to be more invested. And so that's desirable. And for us too, like we build buildings to hold them for a long time. Now, as basically forever, like never necessarily have to sell, right? So, but the thing is, you don't need to sell the building to get the principal out. And so this is what Jarrett was mentioning before, is that every 5 years, if you're managing your building well, and as long as the bottom hasn't fallen out of the economy, the property is going to gradually increment in value because lease rates increase over time. And so every 5 years or so, you should be able to do a refinance and pull out a significant chunk of equity that will pay down the original principal. And so within 10 years for sure, like typically if you're doing construction, you're going to have a 12 to 24 month construction cycle. So you got like let's say an 18-month construction window. Then when you refinance your 5-year term typically on your mortgage, you could do shorter terms, but typically you're going to do a 5-year term on your mortgage. So that gets you to your first, do your construction, do your stabilization of the building. 5 years later, you have your first renewal term coming up. So now you're 7 years into the project. Usually by 7 years in Edmonton, where prices and rents are in Edmonton, usually by year 7, when you refi the building, you should be able to pay most of the investment principal back from that refinance, like 70 to 100% of the original investment capital. You should be able to pay back in year 7, and then after that, it's just revenue. And so that would, when we're talking about like 10 to 15% IRR in Edmonton, typically it's that scenario. So typically it's 2 years construction, refi at that point, get a higher value, 5 years of operation, increase the value over 5 years, do a refi in year 7, and then operate on from then. And you could do another refi in year 12, another year refi in year 17. And that will typically result in about a 12% IRR managed well. Okay? So you don't have to sell to get your equity in.
No, I guess where I'm going with that is just on our end, implementing policies for green building technology, like if you're looking at solar or
Right.
heating as an owner operator.
Yeah.
For the long term, then your operating expenses sometimes lower or even
Yeah, so that's a really interesting point. Okay, so your name? Morgan. So Morgan's speaking to building efficiency and building other types of energy production to the building, and like the incentive to do that on a short term versus on a long term. Here's the problem: it doesn't matter. It doesn't matter. Why? Because in the building owner, from a commercial perspective, is not incentivized to do any of that because all the operating costs flow back through to the tenant. So there's a way around this. There's a function that you can design around this. But a lot of building, and this is important to understand in terms of like the incentive for developers to invest in energy efficiency in their buildings. A lot of developers just get stopped there. They're like, why should I spend money putting solar panels on this building when the tenants pay all the utilities anyway? I put the solar panels up, they're just going to have cheaper operating costs, but it's not going to affect my base rent. So it's not going to affect my net operating income. It's not going to affect my property value. It's not going to affect my cash flow. So there's a nuance there in that if you can lower your operating costs, then you could potentially raise your base rent. But that's an optic challenge because from a leasing market perspective, the tenants are coming in. The first thing they look at was what is the base rent. They may not go to the next step to say, oh, this base rent's a little high, but the operating costs are really low and it evens out. And so that's an important consideration. But then there's ways around it. So if you're a landlord and you're motivated to invest in efficiency in your building, there are ways to set up like a service corp as a separate entity that makes the investment in the building and then charges a service fee to the property. And so now it's an operating cost, and that you can flow back through to the tenants, right? So there are ways to design around it, but it's somewhat complicated. And honestly, most developers don't think that as deeply about it. And so most developers are not incentivized to invest heavily into building efficiency because the incentive isn't there in the way leases are structured.
Yeah, you should just get the trucks.
Yeah. Yeah. Yeah.
Absolutely. And to your point about holding, so we've got a particular model, and because we want to build buildings that will hold and be able to think about it that way. But there's a significant portion of the industry where I don't know what
Go
I
back
just
to
did.
the bottom right corner.
This is his computer. He's got all these shortcuts that I don't have on mine. There's a big chunk of the industry that their involvement ends as soon as this ends. So they've bought the land, they've built the building, they've got the tenants in, they've stabilized it, and then they sell it. They look to sell. So they're not, they're developers, they're not building managers. And so what you can usually see on a return basis is, the development process is riskier, but it's also usually got higher returns. So if everything goes well, you may see a higher return on your investment if you sell as soon as the building gets stabilized. And so for some guys, that makes sense for them from a risk perspective, is that, why would I keep my money in a building that will earn a lower return as a stable asset than it did as a development asset? I should take the money that I would have otherwise had in here, as I mentioned, the shareholders loan that they've inherently got in the building. Let's just sell it. Let's take that money and let's put it back into a development project. Let's start again at the start of the process for the 2 years that it takes to hold and build, because I'm going to see a higher return there. It's a riskier game because development projects go sideways a lot more than stable assets don't go sideways very often. Development projects often go sideways, but that is a bunch of folks, and that's all they do. They just keep rolling the money. They don't hold the assets. And so what I'm showing is a particular model that we take, but even that, because we don't even plan to sell in 5 years, but there's no point building a spreadsheet that never ends because then I couldn't show you guys anything. So.
What role do those, because obviously we market with both, and using higher both, and what role do they play in building the city and looking to, like why the city do we want both of those, or do we want both?
And you mean like people who build to sell and people who build to hold? That's a good question. And I think it comes down to what are we trying to accomplish, right? Like, and what is your, as a developer, why are you in the business? Are you in the business because it's lucrative? Are you in the business because you just like to build things and be creative? Or are you in the business because you're passionate about city building and you're passionate about community and resilience? And so, I think we have to allow for the fact that all kinds of people are motivated by different things. I think as leaders, it's incumbent on us to encourage all conversations to go deeper, right? So that we have more context, we look at the bigger picture, we look at the bigger system, and we think about how can our work in whatever capacity contribute to like the vibrancy and the resilience of the entire region. And so those are big conversations. Yeah, ultimately, I think we have to be the best results come from thinking on a system-wide basis and thinking long-term. And if we reflect, if that interest is reflected in our business model, then we'll be investing in our communities for the long term.
But yeah, I mean, it also somewhat depends, the people that just buy and hold, the people that sometimes it's market, so for example, you don't see a lot of people who build single family homes do a long-term hold, because for the most part, the market for single family homes is people who want to buy a home. And so they're serving a market. People want to buy a single family home. They'll build a single family home. They'll sell it. They're out. Condos, you see a little difference, because there is a more robust market for rental apartments. And so that product may be built as a buy and hold. I mean, so for example, you've got the Ultimate Tower downtown, that was condos, that got sold. Whereas you look at the Hendricks, that was built as long-term rental, and those folks are going to plan to hold on to it for the long term. So you may have an example where maybe there's a developer out there that is building amazing projects, and rather than them be distracted by holding assets, they're building great buildings and great neighborhoods. They can just sell it to an interested group of investors, take that and go jump into another neighborhood and build another building. So I think there's value in having some people who are doing long-term stuff, some people who maybe do some short-term stuff, and so that you can serve a very diverse market. And I think different neighborhoods and different segments of the market want different things, and different developers with different business models are better or worse able to serve those.
I think maybe too the experience that as you have various stages and cycles in a project, the same goes with the developers. We've all come across developers that are in it because it's lucrative, and then you'll see through their career that they will evolve and change.
Yeah.
And you'll hear towards a certain point the word legacy project, and I think that's when the way to shift gear. They're not stimulated anymore by making a profit when the valuation is good off the start. They want to leave a piece to the community. So I think that's kind of answering a little bit the question. All kinds of developers want to get into all kinds of things. But what I see in my career so far is that at one point there will be something that will spark them, and the numbers kind of take the backseat a little bit, and then something else is led to them.
Yeah. And that I think that's also part of what's the state of the conversation, right? Because yeah, people can afford to take more or less risk at various stages of their careers. Like I mentioned right at the beginning, like I started off literally, the company was called Boring Investments. So there's no mandate for any redeeming cultural value in any of that. So yeah, you'll see that. And I think it's also a matter that we can have this conversation, right? We can zoom out and we can look like what are the key drivers that affect the economy in the region, that affect the culture in the region, and how do we talk about it? How do we simplify some of the complexity of that so that lots of people can access some of this thinking? And then what I think you'll find is that the developers who get inspired in their late middle ages to leave legacy projects behind might start to think creatively early on in their careers about ways to do this that doesn't necessarily require taking on a bunch of extra risk. It's more so that it requires investing in relationships and like digging in a little bit in the neighborhood and understanding who the people are and what they care about and what they need and where the resources are. And if you do that work at the community level, then you can creatively structure projects that bridge the meaning and purpose with financial viability with relatively, the same kind of risk profile as another project. So yeah, there's a variety there. Ultimately, at the end of the day, it's better to have some kind of building that can be activated, it's a quality product, than empty parking lots. And so if you have an army of developers and they're motivated by different things, they all contribute something important to the ecosystem. So yeah, every operator has their role in all of that. And as people who are passionate about certain design parameters in urban form, we can be more effective in inspiring people to think more deeply about it if we have a grasp of the basic commercial parameters to make a project viable, and also if we have a grasp on the kind of systemic or ecosystem inputs, like the health of the entrepreneurial ecosystem that affects what's possible in shaping our cities.
In terms of our input to this workflow, when we're talking development agreement, letter of credit, what is the impact on a project of like this magnitude? Like for example, right now, we're going through the revision of our precedent agreement. We've been asked by UDI to drop our letter of credit from 40% to 10%. That would be a value guarantee. What would be the impact of something like that in a project like this?
Letter of credit's like a loan. You don't get the money. You can't use the money. You don't get the money, but you pay like you pay interest, and so it adds to the project cost just the way carrying costs, just the way interest affect the project cost.
My understanding is like it's basically a one-to-one. Every dollar you pass them, you put it down. They need to have that through somewhere else.
That's right.
With that money.
Yeah. Now, if you're a massive company, then they can secure the letter of credit against the value of a large company. And so the other thing that the letter of credit does is it disproportionately impacts smaller community-based investors over large corporate developers.
Yeah. So like in the context of our model, we've got this closing cash balance. So imagine, so let's say that, when we go through and we rejig it, we'll say, okay, we'll keep $100,000 in the bank at all times just for a cushion. But then all of a sudden there's a letter of credit. It's like, okay, imagine that now we need to keep like $300,000 in the bank at all times. We can't use any of it, or we can't use all of it, but it's like having cash in the bank because, the letter of credit, they get loaned one-to-one. Like the bank says, yeah, the letter is 100% of a loan. You either need to put up the cash or you need to borrow it. There's no, and I've seen it. I mean, and that's the conversation in Edmonton is certain large developers are getting the ability to have like blanket letters of credit for all their projects that they can then they only have to allocate up on a percentage of their total need, a much smaller portion, because they say, well, we're the Qualcos of the world. We can afford, a $2 million line of credit. So our whole company will put $2 million aside to cover all of our lines of credit. Whereas a small developer doesn't get to do that. They have to say, well, I've only got one project. I still got to put up my $300,000 letter of credit. So I need to put away that much, which as a percentage of my company is a lot bigger, and it affects my returns and my investments. So.
Returning back to needs to like sort of shift because at the end of the day, if you're paying base rent plus operating, and that gets you to $30 a square foot, like it doesn't matter which percentage those off, right?
Yeah, and it's not, it's not like people don't look at operating costs, and so that's where sometimes the struggle is for somebody with a, because commercial leases are 10 years long. So let's say that, you built a building and you got a bunch of 10-year leases in there, and 6 years in, somebody comes in and says, hey, like, let's put some solar panels on. Well, those leases are set in place. And so there are creative ways to maybe look at energy efficiency after the fact, but certainly it does help. And so, at the upfront, before you sign your leases, then it makes more sense to start considering operating costs. Tenants are going to look at that. And so the struggle and why a lot of people don't look at it is because it's hard to capture at a point in time in a building that has a bunch of leases that are already set in place with maybe, so you got a building and 20% of it's going to come up in 3 years. So maybe in 3 years when you're marketing it, then yeah, you could say, hey, I've got lower operating costs. Maybe on that one lease and that one bay, you can bump up your lease rates by $1 or $2, which if you could do it on your whole building would have paid for that retrofit. But it just makes it hard to capture the cost of a retrofit of an existing building. But certainly that comes into play more often at the development standpoint because, and then, for example, like the Gibbard block, the project we're doing, it's upfront. We're making the investment decisions now. And I mentioned earlier the mechanical system, because mechanical systems are going to have a big effect. You can get, mechanical systems that are cheap and inefficient or very efficient and a little more expensive. And so that would be where you look at it. But had we already built that and it was already in place, and my next lease renewal is not for 6 years, it's like, well, that's 6 years until I can maybe market it. And even then, you may have a clause in your lease that says, hey, we can just renew at market rates, which are market rates for base rent. So it may be 11 years till I can capture, or 9 years till I can capture it.
No matter how hard developers might work, the clients may work, there's to keep that timing off the rails. From how does that get built into the external time factors that are maybe known or maybe not known, and what are some ways that in projects you work to build those relationships to reduce that aspect of the time?
Yeah, absolutely. So, I mentioned earlier, one of the principles that you do when you're doing pro forma development is, a certain level of conservatism. So you might say, okay, well, I think that I should be able to, buy this land and rezone it, and that should take me a year. But you might say, okay, but let's make sure it makes sense if it takes me 18 months. And so you do factor in those timelines. I mean, the world's a messy place. Nobody's expecting that all of a sudden the planning profession that deals with a variety of multitude of stakeholders and inputs and outputs and everything is all of a sudden going to say like, yeah, we're always going to get you everything like right away. So you go into it knowing that there is going to be some uncertainty. There are things that are going to move. Sometimes it's you as a developer, you've done something that's going to stretch your project out. Maybe you've changed your mind like halfway through, or you're going to adjust your zoning. Maybe it's another time where you're not getting a permit from the city, and so you sort of just accept the fact that a lot of this is unpredictable. I mean, development in and of itself is a fairly risky business, and that's one of the reasons is that with this many moving parts, and you guys see a lot of them on the planning side, and there's also all this math that's in the background and everything else. You just sort of take it as it comes. There are things that you can do as a developer. For example, I think that there's a big opportunity in Edmonton. A lot of times when developers come into communities, they come in from a very adversarial perspective, and that has the effect of potentially stretching out rezonings, making them more difficult, not getting what you maybe want from your building performance. And so that would be an example of, if you're going to go into a community, you're going to buy some land and you're going to rezone something. I think that as a developer, going in with an open mind and sort of a community-based approach and going and talking to people and getting their feedback would be something that, I think it's good for the community, it's good for the city, but it actually also probably improves your performa because it's going to make, your certainty a little more. If I know that before I'm going to go into a community, I go meet with the people and I really get a sense of what that community values, maybe we can find something that I can propose that works in my performa. The community is going to be happy. And then it's like, okay, well, when I sit down with the planners, it's like, hey, the community's on board. This is what we're going to do. And it's like, this rezoning is going to be quick because it's not going to be a big fight. We're not going to have to go back. We're not going to have to, deal with all these different stakeholders' intentions. So,
yeah, and I think a principle here is that, and this is maybe part that's missing, right? Is that the stakeholders should know the metrics, right? If the stakeholders understand the metrics, then we can all talk from the same side of the table. It doesn't have to be adversarial. And this is a big part that's missing, right? Like the way kind of real estate tends to work, there tends to be a lot of information asymmetry, right? It's often, there's like an exploitative, like an extractive model where, even within a building, you look at how incentives are aligned, and it's like the landlord's incentive is to maximize rents. The operator, the tenant's incentive is to minimize costs. Those are 180-degree opposite incentives, right? And you have similar types of conflicts of incentives, well, not necessarily, but often, or at least perceived, between the developer and the neighborhood. And part of the challenge is there's a language barrier, right? And like the neighborhood wants to see potted plants and amenities, but the developer has to consider all of this. And again, there's a range of different motivations from the development community in terms of what is the developer just in it to make money, or are they trying to do something that also will have a beneficial impact for the neighborhood? So part of the challenge there is that the neighborhoods often assume the worst. A lot of people in terms of assume the worst about what the motivations of the developer are. And the neighbors aren't necessarily literate in what the metrics are. And so this is part of the challenge. And so the fact that the neighbors aren't literate has the two effects: unnecessarily being adversarial sometimes, and also sometimes not knowing when they're getting the wool pulled over their eyes by some developer. We've seen some examples recently. So so that literacy is really valuable. And I mean, certainly in the planning profession, the highest level piece that can effectively be taught in 20 minutes should be universally understood, because you guys are the people who shape the environment within which these buildings get built and will perform. But you can extend that even further. Like how valuable would it be if at the community league level, the planning, like I'm the planning development officer for Riverdale here in Edmonton. So how valuable would it be if in every community league, the people who are involved with the planning liaison work had basic literacy, had a 30-minute crash course in what does it take for a commercial space to be viable, so they can converse with some sophistication with the developer. Because from the developer's perspective, they come into a neighborhood and they expect the worst from the neighborhood. They're really careful, even because I've seen developers who are super connected with community and just a whole pedigree, their whole career has been volunteerism and boards and community investment, and then they come to do a creative commercial development in a neighborhood, and they don't understand the depth of that person's pedigree, and they just assume that they're there to milk the neighborhood and make a profit and run away, and so it's unnecessarily adversarial because they don't speak the same language, and the incentives are not. It's not clear that the incentives are actually aligned, that you're both working towards the same outcome. So again, literacy, like, the more the stakeholders around these developments have a grasp of the context, the more likely it is that they can have a productive conversation that will result in the best outcomes for everybody.
yeah, just understanding that, you know, it's just sort of one of the strange natures of human nature is that like this idea of fairness, and that, you know, we become very irrational in around how we perceive fairness. And so I see that in the neighborhood level all the time. Developer goes there and, you know, everyone knows that if you're a developer, you need to make money, but the initial impression is always like, it's unfair. This developer is going to come in there, they're going to make so much money on the backs of my community, and even though they might be bringing in amenities that I like, it's not fair that they get to make so much money in my community, and therefore I don't want them to do X, Y, or Z. And so that's where the literacy comes in, because it's like, you know, maybe you can show that, like, you know, and I remember working on a project with the city where I was in the neighborhood and I was like, here's my pro forma, I'm not making that much money. And it was like, wait, you're not making that much money? And I walked everyone through and I said, I'm making a reasonable return, but it's not like I'm milking this neighborhood or milking the city. And immediately everyone was like, oh, well, in that case, let's work together, because now we've got a sense of fairness. And so everybody was sort of willing to say, okay, well, you're going to make some money, and you have to. We have to make money, or we don't get to be developers. And as long as it's fair, I think most neighborhoods, and that's where the literacy piece comes in. If everyone said, well, yeah, these guys, what they're proposing, they're not going to make a ton of money off of it. They're not going to walk into, you know, Riverdale and build a small-scale commercial development on a small lot and make a bunch of cash, because that's just not how this works with the small scales. So,
and there's also another piece that's quite interesting. We have a conversation that's happening in Riverdale right now where there's some city-owned lots that the neighborhood is kind of organizing around having a say about what happens on that site. What's neat is that, you know, people, if you put a kid in front of buttons, they'll push the buttons, right? And so if we have levers that we can pull that have influence, right, like power, then we're going to be tempted to pull those levers. And the challenge with that around the development conversations in neighborhoods is that oftentimes the neighbors the only levers they see in front of them are levers to resist things that would change. And so we get a lot of that, right? People just tend to instinctually want to pull the lever that's in front of them. But it's powerful if neighbors can learn that they have another lever, and that is a carrot, an incentive lever. In that, like in this particular case, we have this site, and the conversation is becoming, because we're conversant now at a legal level with some of this ABCs of commercial viability, the conversation becomes, what would we support on this site? Would we support rezoning? Would we support more density? Like, what do we want from this site, from the developer, whoever shows up to do the development? What do we want to see? Do we want to see some community space? Do we want to see affordable housing? Do we want to see some commercial amenities? And if the neighborhood identifies these are the things we need, the neighborhood can say, you know what? Whoever comes in to do this development, you don't need to worry about your parking variance. You don't need to worry about your density variances. We're going to support that aggressively because we want some density here, because we want to attract a developer who's going to agree to put in the amenities that we want in our neighborhood. So there's actually like a positive negotiating lever that the neighborhood can bring to bear in proactively defining some added value. Because by the neighborhood supporting rezoning or higher density on a given site, you're effectively adding real commercial value to that site. The neighborhood can do that. And so that's an interesting, that's an interesting part of the conversation. As the community becomes more sophisticated, they can have a more proactive role in relationship with developers. And there's even great examples of things like community development corporations, even at a neighborhood scale, where if there's enough leadership with capacity within a neighborhood, neighborhoods can catalyze their own developments to meet specific community needs. And they can do it on all the same investment principles that an investor would do it. And, if they have some capacity and knowledge in how commercial assets work. All right, so we got 20 minutes left, so we'll do a bit of a wrap up and we'll have a bit more time for Q&A.
We didn't even get to test my model. I was going to show you guys how some of this works. Do you want to see how some of this works?
Yeah.
Either that or it'll break and I'll just quickly close it and we'll go to Q&A. We'll see. So the idea was, when I built this yesterday, was that I was going to show you guys a little bit about how some of these levers make a difference. So right now I said, okay, it's an 8.4% IRR. Maybe you can, maybe you can't. An example of something that would affect this would be, if we look here, we've got our 4 bays. They're all different square feet. You're a planner and you say, hey, you know what? I wasn't going to let you, you know, there's a little setback, and we're going to reduce that setback, and that's going to let you take this one bay, and it used to be 3,000, but now, yeah, I should probably remove bay here because that doesn't make sense in the setback conversation, but if this works, and so you say, okay, we're going to remove that setback, and we're going to let you build a bigger space, bigger building, slightly bigger. So I'm going to go, and it's going to 3,500. Now everything's gone up. So what that means is that when we go back to this monthly cash flow, and we go up to where we were showing revenue, where we had our bays, and they're paying the rent. If you remember before, it was 6,250 because that was the 3,000 by 25. Now they're paying more rent. So now it flows down all the way through the bottom line. This is going to test it. So now it's a 10.7% IRR. So maybe that was it. Maybe, you know, because, you know, we couldn't get investment at 8, we can get investment at 10. You really wanted this building. This was in a neighborhood that could really use these amenities, and you reduced somebody's setback. They got a slightly bigger building. Now the project makes sense. You know, or, you know, one of the costs I mentioned earlier during the construction period was this offsite improvement cost. So, you know, I took 150 grand, but now I'm going, oh man, I can't get money at 10%. And the city said, well, you know what? It's really important for this neighborhood, and we're going to put $50,000 in. So we went from a 10.4 to 11.4. So because I paid less for my offsites, my return went up. And this is where it's important to know because, you know, if you're unsophisticated, I could be the developer, my performance sits there, and it's sitting at like 20%. Like you know, there's a project that's going to make a ton of sense. But I go to you and I say, man, you know, this development, I can't make sense of it. Fuck, I'd love to, but you know, could you guys cover some of my offsites? And if you don't know how this all works, you might go like, shit, like, I really want this building. And this guy's going like, fuck yeah, I'll take 22 instead of 20. And so that's where it's like the city needs to sort of, you know, how does this work? So it's not, you know, and that's where Vancouver has a very sophisticated model. And so they force you to turn your performa over, and they know, and they'll go, oh yeah, you're putting this community amenity in, and now it's up to you to go, well, I can't afford to put that community amenity in or I won't make any money. And they'll go prove that you can't make money with this type of commercial amenity. And what you'll find in Vancouver, sometimes they do, they'll show it and they'll be like, if I have to put this commercial amenity and I can't make money, like, okay, well, we'll scale it back and, you know, you can still make money. So that would be an example. And we could go play with all sorts of levers. If I had more time, you know, you could stretch the timeline out and you can see how the IRR goes down. You could shorten the timeline. You can see how the IRR goes up. You can see how construction costs are going to make a difference. Land costs make a difference. You know, interest rates. We can get interest rates. You know, the Bank of Canada is increasing, you know, their lending rates, and so that's going to be something that's going to be coming up for a lot of people in real estate that hasn't come up for a long time. Is this notion that like interest rates have been super low for a long time, but they're on their way up by the looks of things. And so what's that going to do for your different projects? And that makes your carrying costs even higher and everything like that. And so all of this sort of really flows together and starts driving returns. So that's sort of what the model is. But yeah, like Antoine said, I think we're probably going to do Q&A. I mean, I can change more stuff on this if you guys want to see it. I'm impressed that it worked. But other than that, yeah, we'll just sort of probably take questions. Yeah, absolutely. So let's go back. We're going to take. Yeah. So you. Yeah, I'll just add $50,000 onto one of these divisions because it doesn't really make a difference. So now it's 50 grand more, and so we had it at 10.4. Now we're at 9.9. So no. That's where you know, knowing how this works, it makes the give and take a little bit better because then maybe, you know, you're sitting at a 12%, so you're in an investable range, but you still want something. So then it's a give and take. So I want this. It's going to cost you $50,000, but I'm also going to do something so that the give and take ends up at the same place. How can I do that?
Another thing that we've seen pretty much everybody has experienced in the matter of timeline is how fast the turnover of what is needed can happen on the part of the developer. So there are certain things that cannot be skipped. For example, you need to revise engineering plans, you need to revise servicing, grading, stormwater, drainage systems. You need to take that back to your consultants how fast we can put it back to the pipeline. So maybe one of the things that you guys can work into your contract with your consultants is they're gonna pay the penalty or contribute to the penalty on extended timelines because because your contract report, then you cannot return that back to the system to put it in. And sometimes that's a big battle, and yeah, sure, it makes sense, but work with me here. I have a process and that I have to feed, and if you don't give me information to feed it, nothing's going to move forward.
Yeah, so as developers, we're not actually allowed to admit that delays are ever our fault. So, like, I mean, yeah, sure, we didn't provide the right information, but, you know, it's always the municipality, it's always the city. That's, yeah, we all developers have to sign a little thing, and so we all have to sort of agree that we have to have the same message on that. But no, it's a good point.
Hippocratic oath.
Yeah, everything is always the planner's fault, never the developer's fault.
Yeah, it's like the customer's always right. Yeah, the planner's always to blame. All right, cool. So yeah, all of this distills down to what are the design imperatives for city building, right? And we've kind of, everything that we've talked about has hovered around these two drivers. On the one side, there's the idea of cultural vibrancy or vibrant culture. And then there's the idea of resilient economy. And, you know, this is reciprocal, right? So you have a strong economy, you have jobs, you attract people, you can sustain good restaurants and music venues, and then cool people are attracted, so they come and they start businesses and they innovate and they employ people and they throw block parties. And then this is a reciprocal kind of process where great culture attracts great people bring leadership and innovate, and you have this ever improving, you know, collisions, cross-pollination, innovation, wealth, well-being, security, you know, good social fabric, and then you just want to party, have festivals. So this is the kind of reciprocal engine, the driver of great city building. And we all are part of this machine in some capacity. Whether this engine is turning over or not, whether it's going in this direction or the opposite direction, we all play tiny little parts. And it's really easy to kind of just like be focused on the task at hand and limit what you're interested in to the direct imperatives of your job description. But what we're advocating for here is that it behooves us in the extent to which we are leaders in our communities to zoom out and understand things and understand the systemic dynamics. And so in terms of buildings, what we've shared about net operating income, cap rate, value, and how all your work affects those things and what the other considerations are the developer has to deal with affect the outcomes of the development. That's really important. Now you're starting to get into like the underlying mechanics. You're looking under the hood of how these projects work that you're trying to proliferate in the city. And then there's also like, what is the macro context, which also behooves us to understand. So, you know, cultural vibrancy, these are the things that make a neighborhood worth living in, right? This is, at the end of the day, you want to be able to hang out with your friends and have good food and coffee and music and good time. But, you know, this is a really important question. And so, you know, if you're working in a municipal environment, a good question to ask is, where are these conversations happening? Where's the intelligence around this? Where's the leadership going deep? And, you know, some of the questions become like, what are we doing about strengthening the entrepreneurial ecosystem? What are we doing to support that leadership at that level? That is the dynamic that actually shapes our neighborhoods. And then the other question to ask is, where's the conversation about what is the macro context? Because we have to appreciate when we talk about resilient economy, we're talking about it in a very particular context, which is the 21st century, right? And we're dealing with some massive changes. So we're dealing with things like wealth distribution, right? We're dealing with like 60% of the wealth controlled by 10% of the population at the end of the 19th century, 35% of the wealth controlled by 10% of the population in 1950s and 60s, Now we're back up to 85% or 60% of the wealth, 55, 60% of the wealth controlled by 10% of the population again. So we're in an environment where wealth distribution is magnifying. Then we've got all the new exponential technologies that are changing the world, right? So right now, I don't know if you're aware, but every mine up in Fort McMurray has a section of the mine that's hived off for autonomous trucks. So there's self-driving trucks that are driving around today, every day. Suncor bought a fleet of 150 trucks. It's going to put 450 truck drivers out of work. The new trucks just look like this. There's not even a cab. It's just a box. So, you know, that's impacting labor. We think about autonomous vehicles, like starting that 20 years from now, we're going to have some significant portion of market share. You know, what does that do to labor demand when 2% of the entire U.S. workforce is directly employed in labor? What does it do to labor demand when your car goes from being parked at the curb 95% of the day, the average vehicle being parked at the curb 95% of the day, to the average vehicle being used 80% of the time, you know, 50% of the time? You know, if our cars are being used 5% of the day and we're going to go to 25% use, that effectively results in a 75% reduction in automotive demand worldwide. What's the impact of that on labor demand, right? And in the meantime, these technologies, automation, artificial intelligence, these are all technologies that basically impact this dynamic, right? So more and more of the value in the economy is being captured by capital because somebody owns the robot, somebody owns the algorithm, right? And less of the value is being created by labor. So that has an impact on labor demand. We have changing population dynamics in all the developing countries. Our populations are stabilizing, right? We have an aging demographic as well. So these are all massive macro factors that are going to impact our economy. And I would recommend when you go home, go to YouTube and look up Wired Magazine has a documentary about Shenzhen, which is a district just outside of Hong Kong that has been the manufacturing capital of the world for the last 15 years. It's a town that went from a population of 300,000 people to 10 million people in 20 years. So think about that from a planning perspective. Yeah, and so it's about an hour-long documentary, and it talks about the innovation ecosystem in Shenzhen, right? So this is a culture where there's no such thing as IP. There's no patents. I mean, people do have patents and IP, but nobody respects them. And so it's an open source. It's an open source culture. Everybody shares their information, and they become this. Like you can literally go down to the bazaar in Shenzhen and go into these little shops that have like a little garage door that closes them, and you can buy electronic components that come from this region, and you can actually build an iPhone yourself that is as good as an off-the-shelf Apple iPhone. And so this is an example of this incredibly rapidly evolving innovation culture that is not constrained by some of the siloed interests, the way we separate our business interests in North America. They're not constrained by that. And so they're accelerating really rapidly. And this is all part of our context as Albertans. It's not just a matter of having nice buildings be built and trying to balance the budget. It's a matter of looking to the future and asking the question, are we prepared as Albertans for the 21st century? Are we prepared to compete in an environment where our primary industry has a lot of risk associated with changes in energy demand and in changes in how technology is impacting these industries? And it's like, do we have the social and entrepreneurial fabric to be able to sustain a resilient economy in the face of all these changes? These are important questions. Of course, this is outside of scope. It's outside of scope for you, for me, for us, but these things are going to affect our work. And so the extent to which we can broaden our perspectives, look deeper into the details of how do the engines work that drive our cities, and then look broader at what are the outside trends that are going to influence us, and then ask the question, even if it's not something that you can have time for in your career or in your work to do something directly to impact these trends, at least we can be asking the question, where are these conversations happening in our city? Like, where is the leadership that is looking at the broad landscape and understanding how we need to be positioned so that we can produce these outcomes in the short term versus in the long term. And the thing is, we have to be willing to stimulate our imagination around this, because there's a lot of things, there's a lot of dynamics about how things work today, and there are like seemingly really hard constraints about how the rules work and how the business works and how people tend to do things, that they're used to doing it in a certain way and it's hard to change. But none of that matters. Like, we're entering an environment where we have to be willing to disrupt things. And just because your planning role has a limited scope doesn't mean you can't ask questions that are going to make people uncomfortable. And so the thing is, we all agree, like, I don't think anybody will disagree that these are prime values. Whether you're talking to a developer or you're talking to a resident in a neighborhood or you're talking to a tenant, we all can appreciate the importance of these two things. So we have an aligned incentive, broadly speaking, as citizens. But the problem is that our systems don't always necessarily reflect that. I listened to a lot of podcasts, and just last week I was listening to a podcast by Sam Harris that's mostly like philosophy, neuroscience, and politics. They're the three major threads. And it was just brilliant because it was a live event, and somebody asked the question, is there an ethic that we can have in our consideration that would help public policy, public debate, and how we discuss our communities in this country and the world? So he's asking, like, is there, like, everything's so polarized, is there some middle ground that we're just missing, like some essential point that if we just hold on to that, it would help to bring the conversation together? So Sam answered this. He said, largely our failure is not a matter of there being so many bad people in the world, or even that there are so many people who want fundamentally different things out of life. Okay, that's not the problem. We have incentives that are badly aligned. We have people who can't agree to change their behavior at the same time in ways that would be advantageous for everyone, because it's a coordination problem. So ultimately, it has to be a matter of ideas and better messaging and better stories and convincing enough people to change things that need to be changed, but the changes will have to be institutionalized. They have to be inscribed at the level of culture as the operating system, so that mediocre people like ourselves don't have to get up every morning and be saints or recommit to some new heroic ethical norm that we can't quite get a purchase on as apes. We need to be incentivized, as we are, to effortlessly be better and cooperate better. And so this is the imperative, right? If you're talking about city building, if you're talking about planning from a strategic design perspective, the essential design challenge to achieve these outcomes is, how do we create aligned incentives? And so today we're talking about, first of all, speaking the same language as the first stepping stone to creating aligned incentives. And then from there, there's some disruption that's required, because there's old patterns that need to be broken up gradually. And ultimately, that's on you and us. Right. Great. Any other questions before we wrap up? Awesome. Okay. Thanks so much.
So thank you, Jarrett, Antoine, and Chelsey, on behalf of APPI. I find this stuff fascinating because I think Jarrett said, I think we all know those developers that are always telling us that they can't make money off things when they're making money off things. And then I think it's good that we remember sometimes that some of the requirements that we add do cause some problems in this long term of getting better cities and all those types of things. So thank you very much. A small token from APPI as a thank you for coming today.
Thank you very much.
Thank you, Chelsey. So just a bit of housekeeping. Don't forget to log your CPL units. This just earned you 3.5 CPL units for those